If anyone's telling you that the market action is inconsistent with action seen at previous market peaks, or if anyone tells you that Federal Reserve action is inconsistent with what we've seen in the previous market peaks, I would show them my technicals at the high and show all of these things are in my table, and all these things are consistent with what you've seen at prior market peaks.
You're saying that you're seeing signs of market.
I'm saying that no one can argue that the market can't peak now based on technical data. They can argue that we're not at a peak, but they can't argue that we can't peak. I'm going to share with you and your readers, your viewers, things that they've never heard about Bitcoin. You have a lot of factors telling you the market's topping. That's why I'm short.
Do you think we have a multi-decade bear market in gold, Milton? Later on, you'll hear more about the Fundrise Income Fund and why sophisticated investors are turning to higher yielding assets like private credit. But for now, let's get into today's interview. In this interview, I'm speaking to the turning point master himself, Milton Berg. 9 months ago, Milton came on Monetary Matters with an extraordinarily bullish case for U.S. stocks, which are now up nearly 20% since that interview. Our talk today is very technical and quite long, so I want to give you a little bit of a roadmap. The first 20 minutes or so we devote to the incredibly strong buy signals that Milton saw in April 2025 that nearly 1 year later are still motivating his analysis. At the 22-minute mark, Milton talks about the disturbing December signal that made him short the market. At the 1 hour and 12-minute mark, we talk about why Milton is bearish on gold and silver and why he thinks that late January was a climax top for precious metals. At the 1 hour and 37-minute mark, Milton talks about Bitcoin. And just over 2 hours in, we talk about the vicious sell-off in software stocks. I also want to make clear that this interview was recorded on February 6th. And at that time, Milton, in his model portfolio for institutional clients, had combined short positions of over 100% in the S&P, NASDAQ, Russell, as well as semiconductors. Based on what he saw Monday, February 9th, not only did he cover those shorts, but he also flipped long equities. Again, that is for his institutional clients. In his new retail service for individual investors, Milton's signal has had a 100% long exposure to stocks since early April 2025. Also, when it comes to precious metals, Milton shorted gold and silver within 1 day of the high in precious metals at the end of January, and he remains bearish on gold and silver. Let's get into it. Got a very special guest. I'm joined once again by the extremely accomplished technician known as Milton Berg of MB Advisors and Milton Berg Edge. Milton, it is wonderful to see you. How are you?
I'm doing very well. Thank you so much. Good to see you again, Jack. Always enjoy interviewing with you.
The feeling is mutual. Milton, about 8 or 9 months ago, shortly after the seismic panic in markets of April 2025, you and I did an interview and you were extremely emphatic that the market, the technical signals in the market you were seeing were extremely strong. And you used extremely strong language.
This time I said, we have a series of buy signals. There's no way the market could go down. It's definitely going to go up. How long it goes, I don't know, because you had similar signals in 1987 in January, and the market peaked 3/4 of a year later. So I can't tell you how long the market's going to rally, but I will tell you how high the market should go. And that's what we'll discuss today. I said definitely going to be bull market action.
You promised bull market action. Bull market action. We've had the indices are far higher now. Funny you referenced 1987. That was a very good year for you. Then in the background, people can say you were the mutual fund manager of the year. Quite an accomplishment. Milton, what were the buy signals you saw in the market? How have they evolved into January and now February 2026? And what have you made of the recent market action? Are you seeing any sell signals?
Okay, I'm going to get back to what our projections are. Now, we don't trade based on projections. We trade based on turning points. April was a major turning point for the market. And we pounded the table. Basically, we don't always pound the table. We pounded the table, buy, and I'll tell you exactly why. Now, this chart was the first of 88 buy signals we received. We received this buy signal April 4th of 2025. I say it's the first of 88 because our retail newsletter only gets the first signal, and we say you buy now when you hold till we tell you to sell. Institutions are constantly comforted. They give more confirmations, and they see many of the signals we get. But this was the first signal we saw on April 4th. It was the day before the low. On that day, the NASDAQ's 5-day volume was at a 200-day high. On that day, NASDAQ had declined 7% over the last 3 days. And the VXN, which is the VIX on the NASDAQ 100 rather than the VIX on the S&P 500, gained 10% for at least 2 days in a row. And this is a very rare occurrence. We're looking for rare occurrences. In other words, we're not looking at moving averages and looking at what the Fed is doing and what the Fed is saying and the money supply. We're looking for rare occurrences that take place at market turning points. And on this day, April 4th, you had these three rare occurrences, which I just mentioned. This actually occurred in the past. It occurred in October 8th, 1998. August 5th, 2024, and August 24th, 2015. And the gains, the maximum gains within a year of those signals was 47%, 15.6%, and 23.2%. So far, the April 4th signal through the closing high on January 27th of this year, it's gained 37.53%. So it's outperformed two of the historical precedents. It's underperformed one of the precedents of 47%. However, we're measuring 1 year out. We're looking at the maximum gains within 1 year. For all I know, we'll be up 47% by April 4th of 2026. So this was the first signal we got. However, I want to talk about projections. Why did we project to our clients? Now, again, we don't trade based on projections, but projections are very important. Important because if you get a buy signal, it would only, and historically, the median gain after that buy signal was 5%. It really doesn't pay to trade it because, you just with the slippage and with it just doesn't pay. So we look at the historical returns based on the signal and tell you what the market would do if we follow the historical returns. And it's very helpful for us. So what we did is, for this chart for you guys, I actually created this for you. We broke up our signals by day. So on April 4th, we actually had two signals. I showed you one of them. And based on the signals we had on April 4th, the median maximum gain before the market declined 10%. In other words, how far did the market gain before it declined the next 10%? So the median was 60 to 67.57 relative. We're using percentage gains relative to where we started off on April 4th. And the projection on average would be 71.52. Our maximum high to date on the closing basis was 69.78.60. So based on this alone, there's more to the upside, you see, before the market sees a 10% correction. That was April 4th. On April 7th, we had a number of signals as well, and that projects it to either 72.91 or 77.51. Again, the market could go much higher based on those projections. On April 8th, we had more signals with many more historical backups to the signal, many more historical precedents, and that projected to between 71.28 as a median, 67.28 as an average, and we've actually exceeded that by closing at the level we closed at was 69.78.60. We've exceeded the average of previous returns. April 9th, we had many signals. I think we had about 40 signals on April 9th itself. We had many historical precedents for these signals. Each of these instances that says historical signal is an actual historical date of the signal. So what signal on April 9th signal looks like 30 or 40 times in the past. And these 57 signals generated April 9th project to between 74.87 or 79.21 before the next decline of 10%. And we're only at 69.78.60. Now, again, I don't trade based on projections. I just give the clients, this is institutional work. The retailers will not see this kind of work. But we tell them how far the market would go if it just gains the median gain or just gains the average gain based on the previous signals. This is April 9th. This is April 10th. I won't go through each one. April 11th. Summary, looking at all the signals from April 4th through April 30th. Many buy signals, as I said. The median projection would be to be 74.37 in the S&P. The average projection is 75.99, which means from the closing high on January 27th, it's about nearly 6% and about 8.5% from where we closed. The actual high is 69.78. You see, so again, based on the kind of buy signals we saw in April, the market has not satisfied its historical gains. It has not satisfied its historical mean or average. It hasn't satisfied its historical returns, as you'd expect after that kind of low. I just point out that the low in April generated the most extreme oversold condition we've ever seen. This is based on a combination of 18 oversold indicators. And the indicators go back only to 1995 or so. So maybe you saw it prior to that. But in any event, from 1995 to 2025, we had the most oversold. And the reason is why. Half the country hates Trump. Half the country thinks Trump's going to cause the Great Depression. And the other half of the country that loves Trump hates Powell. So they think Powell is going to cause the Great Depression or hyperinflation. And when Trump announced tariffs and he great negotiated, people thought rather than people laughing at him or laughing about it, they took it seriously and they thought they were going to have 100% or 200% or 300% tariffs on China, whatever Trump decided on that particular day. And people truly panicked, and market bottoms always occur on panic. So our signals flashed on the days, April 4th into the low, April 8th day of the low, and April 9th day after the low. So you signal at the oversold readings into the low and at the thrust off the low. And again, projections look for, say, another 6% above the current high, which is not a lot. Another 6% is not a lot for an institutional trader who's trading. Some people are trading trillions of dollars, but those who are trading even billions of dollars, you're probably going to start worrying about the market now if the median projection is 6%. But we don't tell our clients that we really worry about projections. We worry about a turning point analysis, and we'll see in a minute that actually looked a little bit cautious. We'll get to that in a moment. I just want to review some. I took from each date just one signal, just to give your viewers an idea of what we look at, because up until this point, you could say this Milton is just really, he's just sort of like saying he has all these indicators, but why should we believe him? I mean, why should we believe there's some robust indicators? I mean, for all we know, he's like all these charlatans on Wall Street who claim they know what the market's going to do, and everybody knows they can't project the market, and everyone knows the market is efficient. So what exactly does he have? So I decided to take one signal for each of those dates in April, just to review what we saw on those individual dates. So for example, April 4th, we had two signals. This is just signal one of two signals. And as I said, the Nasdaq's 5-day volume was at a 200-day high. The Nasdaq had lost 10.61% over 3 days. The threshold for the signal is losing 7%. And the VIX traded between 45 and 60, which is a rarity. The VIX in our case was 45.31. That generated signal, gave you the buy signals. As you can see, these are the two historical buy signals. This is the great buy signal we had on April 4th, the day before the low. April 7th, 2025, we also had two signals. Now, what do you see in this one? First of all, instead of looking at the Nasdaq volume, we're looking at the New York Stock Exchange total volume. And its total volume was the highest in 370 days, sometime within the past 20 days. Now, what does that mean? It means we're in a regime of high volume. People who know markets know that turning points take place in a regime of high volume. You don't necessarily see the highest volume on the day of the low or the day of the high, but you just see very, very high 5-day volume sometime before the low or sometimes before the high, and we use 20 days as a threshold. So if we saw 5-day volume in the New York Stock Exchange, highest in 375 days, which is a year and a half of trading, we saw that within the past 20 days, we know we're in a regime of high volume. Now, that's number one. Number two is there's an oscillator generated by Ned Davis Research. I put that for this indicator, but we actually have made some minor changes. But in any event, that oscillator was at 10. It runs from 0 to 100. The oscillator was actually at 4.44 on April 7th, 2025. It ranges from 0 to 100. Obviously, it was major oversold. And the threshold here, if it's 10 or below. The third indicator is you take the new highs and new lows in the NASDAQ on a 5-day basis, and you took the percentage of new highs to new lows. In any event, it was oversold at minus 16%. And this, again, occurred at the lows in 1998, occurred at the lows in 2018, it occurred at the March lows in 2020, and occurred on April 7th, 2025 at the lows. So that's one signal on April 7th. We already showed you the projections, but as I said, anyone can show projections. We want to get under the hood and see exactly what we're signaling. Again, we're not using moving averages, we're not using crossing, we're not using Fed, we're not using seasonality, we're not talking about, if the market's up the first 5 days of January, we'll have a bull market. We're talking about precise rarities that occur at marking turning points. So let's see what happened on April 8th. April 8th had four signals. This is one of the four signals. The NASDAQ 5-day rate of change was weakest in 1,260 days. You know what that means? That's in 5 years. The 5-day loss in the NASDAQ was the greatest in over a 5-year period. Of course, everyone would agree that's a rarity. You don't see that every day. In this case, it was down 12.50% over the 5-day period into April 8th. Then, additionally, the SP 500's 4-day advanced decline ratio generated what we call a reverse thrust. First thrust means instead of being 2 to 1 or 7 to 1, or a day like today, let's see where it is today. Today it's about 3 to 1, right? There it's 0.2 to 1. In other words, so you were overwhelmed. The 4-day AD line was overwhelming on the downside, and it was below.
Meaning the amount of stocks that were declining as opposed to advancing was overwhelming.
Overwhelming to the downside, yeah. But extremely overwhelming. Extremely overwhelming. We're not looking at averages. Okay, let's continue. Then April 9th. April 9th, they said we had 50 signals or so. We really have more, but, my mind and my computer can't handle much more. Let's see what we had on April 9th. April 9th, the market was up 9%. The S&P was up 9.52% on the day. The Nasdaq was up more than 9%. You had overwhelming 95 to 1 upside downside volume, but this is not what this indicator is showing you something else. S&P was below its 50-day moving average, meaning that the S&P was, by definition, by some people's definition, it was in a bear market. That's the first criteria. That's really nothing. Secondly, the market gained at least 6% from its last time it declined 10%. In other words, happens to have been declined 18% into the previous day's low, and this day was up 9.52%. So by definition, it gained 6% from its last 10% decline. But just to be precise, it's not enough if it gains 6%. This has to be the highest high off that low. So in other words, the S&P lost 10%. It's now up 6% off that low, but today is the highest high off that low. So that again reduces the number of days, because in any bull market, the S&P is up 6% from its last 10% decline. But it's not enough to be up 6% from the last 10% decline. This has to be the exact high day since the 10% decline. Okay, next one is the S&P generates greatest gain in the last 250 days, which is about it's roughly a trading year, and that's it was up 9.52%, the greatest one-day gain. And on top of that, the S&P's volume on the day had to have increased by at least 20% over the previous day. In this case, it increased 38.28% over the previous day. And the second condition is it has to be an up day. So very often the market crashes, the market is down on the day and volume increases by 20%. This indicator needs the market to be up on the day and volume to have increased by 20%. When all these four things come together, you saw bottoms in 1976, you saw bottoms in 1982, you saw bottoms in 1984, you saw a double bottom in 2022 and 2000 in June and in October 2022. Jack, if you recall, we met then. We had a discussion then. I pointed out that Russell actually bottomed in June, and the S&P bottomed in October, and the Nasdaq bottomed in January, in December. So both of these calls were correct. We had a buy signal at the bottom in June and a buy signal at the bottom in October. The June signal actually was the bottom of the Russell, never made a lower low. And the S&P made a low about 2% below the low of June, and we got a buy signal then in October. And again, you had a buy signal on October 9th, 2025. This is one of 57 buy signals, just one. Again, my point is to show the robustness of the signal. I don't want to show off too much, but no one on Wall Street has this kind of information. We're really the only one. This particular models that we have, I just finished. I mean, institutions have been writing letters and working with institutions for quite a number of years. But I've been on the side, basically, I've been working on creating these models, and I just finished it in September. So a lot of things you see now was really relatively new. I wasn't able to show it to clients a year ago, or 2 years ago, or 3 years ago, because we didn't really finish creating the models and fine-tuning the models and eliminating models that didn't have perfect records until September. So April 10th, 2025. And again, when you show the top of it, it's the first time this ever signaled. So the first one, for example, April 4th, the first time it ever signaled was October 8th, 1998, you see? The one on April 7th, the first time it ever signaled was September 1st, 1998. The April 8th signal, the first time this particular indicator ever signaled was March 27th, 1980. And the first time the April 9th was on April 14th, 1978. And then we have another signal on April 10th, 2025. And that signal, the day of the crash low in 1987. What is the signal? Basically, the 7-day volume breath, no polarity. No, the model doesn't care whether the volume was up or the volume was down. All it cares about that on a 7-day basis, you have 12 times as much either upside volume or downside volume as the other side. In other words, either 12 times as much upside versus downside or 12 times as much downside versus upside. The model doesn't care which extreme it is. All the market cares about is that it's at an extreme. In this particular instance, by April 10th, the 7-day volume breath was 12 to 1 on the upside in the New York Stock Exchange. The 7-day volume breath in the Russell 2000 was 10 to 1. And the 10-day volume breath in the Russell 2000 was 8 to 1. And on top of that, New York Stock Exchange volume on a 5-day average was the greatest over the last 3 years. These four rarities put together have signaled 17 times in the past, as you can see. In each instance, a bull market followed, and that's where we're able to pound the table and say a bull market will follow.
Thank you, Milton. So it's fair to say you were able to spot in April at the low, a few days within the low, overwhelming signals of the market bottoming that turned out to be correct. And what's interesting to me is we're already, close to a year out, and the S&P has up 38%, maybe 40% from there. And your signals from April are so strongly bullish that you want more. You're saying 5%, 6%.
Well, I tell you like this. This is very interesting. I'm glad you bring it up. First of all, we haven't had a 7% correction since April lows. We got a 5% correction within 3 days of the low, but you never had a 7% correction. Forget about 10%. More than that, it's glad you mentioned. An analogy that came up in a previous interview was, when who's a great baseball player? I mentioned Ted Williams or Babe Ruth, but nowadays there's the guy Ohtani, right?
Yeah.
When Ohtani swings the bat and hits a home run, based on physics, the physics knows that the ball will cross over, will be a home run over the fence as soon as it leaves the bat, right?
Mm-hmm.
There's nothing going on after it leaves the bat that's keeping the ball up and telling it to cross over the fence. It's the momentum of the action and the physics that took place when the bat hit the ball that tells you at that time that it's going over the fence.
It was a launch. It was the launch, a force in space.
Right. So what we're looking for on a buy signals are launches. Mm-hmm. So the fact that the market was able to have a 95 to 1 upside volume day, one day after the low, and other things we look at, that tells you there is underlying physics, underlying momentum, underlying strength that doesn't dissipate in 5 days or 10 days or 20 days. And generally it lasts a year or longer.
And Milton, I've got to ask you, so it was a very strong thrust from that bottom on April 8th, around there, until the very late October 29th, 2025. Since then, it feels the market's been feeling very bullish, but we're kind of in a holding pattern. And I'm sure you're going to reference buy indicators, buy signals, and sell signals from April 2025 all the way throughout the fall and winter. But just if possible, could I bring you back to the current moment right now?
Well, we're going to get there right now, but I wouldn't say it's worse than you say, because we got signals in April, we got some signals in May, no signals in June, no signals in July, one signal in August, which is really not part of the model. I don't really trust that signal. So there's no really confirming signals throughout the bull market. All we have is what you had in April and May. It's all we have going for us. And yes, as you saw, the market really isn't doing as well as you'd expect based on the signals. Right, we showed you really underperforming. We should be up another 4, 6, 8%, but maybe we still may get there by the time the year is up.
Have you got any sell signals recently?
First of all, we wrote a report today. I think you should first start why I talked today and what we wrote about the last week or so. Okay.
Yep.
So this morning's report is right here. The market is strangely oversold, not ready to cover equity shorts. In other words, there are reason to believe, even though the market has to be only declined 2.58%. Over January 27th all-time high. And even though the NASDAQ has only declined 5.92% from October 29th high to yesterday's close, and the Russell only declined 5.19%, so certainly no major bear market, really just a minor correction, still VXN has gained 10% for 2 days running. VXN has gained 35% over 3 days. NASDAQ has generated its weakest 5 days in 180 days. And 5-day volume in most indexes, most of them, both the small caps and the large caps, are at 180 to 200-day highs. Now, what does that mean? I'm going to show you something here. There's only one time in history that you saw what you saw yesterday, which is the NASDAQ index generating its weakest 5-day gain, or actually 5-day loss, weakest 5-day gain in 180 days. The S&P, the NASDAQ AD line declining 8 out of 10 days in a row. In other words, 8 out of 10 days you had a declining AD line. And the VXN gaining 35% over 3 days. These are 3 rare indicators to see. And for them to happen on one day only happened once. And guess when that happened? It happened as a sharp short correction in 1997, right here. See? Now, what have we had now? We had a sharp short correction. The Russell peaked in late January. It's still early February. The mid-caps peaked in January. The SOX index, the semiconductors, peaked, I think, on January 30th. Or maybe, so they just peaked 2 or 4 days ago. A sharp short correction, which caused the NASDAQ to have its weakest 5-day gain in 180 days, and 8 out of 10 days, a declining AD line, and for the VXN, which is the VIX and the NASDAQ, to get 35% in 3 days. And when did it ever happen? Once before, not during a bear market, during a minor correction. It took 14 days, this correction, you see? That happened again yesterday. So that's the reason to turn bullish. In that particular instance, the market gained 35% without a pullback. It gained a full 39% without a pullback, you see? Today we're having a very big day. We're having the biggest day since May in the markets, right? I mean, you look at
today we're recording Friday, February 6th, extremely strong market.
Right. I mean, today you look at the SOX index, which looked like it's breaking down. SOX is at this moment of 5.59%. Okay, anyway, there's one reason to consider covering shorts. Then let me continue with this report. There's another reason to continue covering shorts, because the VXN gained 10% for 2 days.
Milton, I'm sorry. I guess I got to go back. First of all, why have you been short in your model portfolio?
It's important that I say what we saw today. Okay. And I'm going to get back to exactly why we're short.
All right.
It's actually in this report. First, our clients, if they're following what I'm saying, they're short. I myself am short, right? The problem is you see action yesterday that suggests to cover the shorts. We're going to see exactly why we're short and whether the evidence we see today is sufficient to cover the shorts. Based on what I just showed you, only had one precedence. In a sharp, unexpected decline that lasts just a number of days, you saw these indicators, which exactly happened yesterday. In that case, the market, that was its bottom, and it gained 35% before its next high. And the second thing we saw was this, where the VXN gained 10% for 2 days running. VXN gained 35% in 3 days, and the Nasdaq's 5-day decline was the greatest in 180 days. This happened 8 times in the past, and let's just show you the instances. 1998, it was at a market low. S&P gained 38%. Happened twice. In 2010 was during the flush crash. In this case, the market went down another 7.9%. So see, it's not a perfect indicator. October 13th, 2014, the market gained another 13%. Bottom 2 days later, down only 0.75%, gained 13%. August 21st, 2015 was the day before the low, of which for that instance, the market gained 7% in 51 days. So the next day, which was another buy signal, it gained 11% in 50 days. And then you have August 5th, 2024, after a sharp correction in the S&P, the market bottomed on that day and gained 18.468. And it signaled on August 4th, 2025 as well. This is not part of a model. These are the kind of things we study each day. Our models are fixed. When they signal, we know they signal. Every day I look at our indicators and see what it's telling us. This is one of the things it's telling us. So basically, I'm telling myself it's quite possible that what we saw yesterday was a low. I want to see some more confirmation. Maybe it's not a low. Maybe it's going to be more like the flash crash. In this case, right, where the market went down another 7.9%. We've never seen this action early in a bull market, a bear market. Let's put it that way. We've seen it during corrective periods, and the market bottoms 1 or 2 months later at the worst. We've never seen this kind of action early in a bull market.
So that's very promising, Milton, that the action that we saw yesterday on Thursday, February 5th, you have seen in multiple local bottoms, suggesting that it's a bullish indicator.
It's not enough for me to cover my shorts. But when I realized that the S&P was down less than 3%, Nasdaq was down less than 6% off its highs, and still you saw panic in my indicators, these rare indicators, that suggests that we're all going to be fooled and the market could take off. But I haven't triggered this yet. And I realized my retail newsletter clients are still long because they had no reason to get out. They're not traders. They're long-term investors. We'll get to that in a moment. And they're sitting pretty today. My institutional investors are not. Because either they may be short gold, maybe short stocks, maybe short the Nasdaq, maybe short the Russell, maybe short the S&P, and they're all screaming today. But this is why we went short. This is the reason we went short, right here. Okay?
Yep.
And I'll show this later on. We got a sell signal on December 11th. See the December 11th, 2025? We got a sell signal. This sell signal does not always work. Okay? In other words, this sell signal is telling you that the VX, I don't want to give you the secret sauce, but it's looking at a short-term rate of change of the VXN, which is the VIX on the NASDAQ, relative to another short-term VXN, which is longer than the first shorter term. In other words, we want to see a sharp shift in the VXN on a short-term basis relative to the previous short-term basis. If I had to give you a number, I'd say 5 days relative to 30 days. I'd tell you 10 days relative to 30 days. Those aren't the real numbers. Anyway, these give
is it an increase in the NASDAQ mix index or a decrease?
Increase on a very short term, rather over previous short term.
Okay, you can tell me after the call, Milton. But for now, yeah.
Okay. Yes, I guess I could.
Yeah.
But listen, so in this case, this catches bear market rallies. In other words, signals when the market's up 18 or 15% in the bear market, it catches rallies. It catches major bull market peaks. But during an extended bull market, which you may be having now, it gives a number of false signals. I've pulled out the successful signals from 1998. And we're tracking, is the market's following what it does when the signals are successful. If it's not, we get out of the short. You understand? In other words, we're going short on a probabilistic basis, knowing we may be wrong. Mm-hmm. So let me show you what we did. You know how much the market has gained since December 11th? If you wouldn't look at this table, what's the maximum gain since December 11th? Everything's talking about the great new year and the bull movement, right?
Okay, I'll guess 7%.
What the market's S&P gained a maximum of 1.12% since December 11th. That's all.
Really? Wow.
I can show you the chart if you'd like.
I believe you.
Okay.
If there's anyone I believe, Milton, it's you.
From the December 11th close to the January 27th close, which was the final all-time high in the S&P, it's only gained 1.12%. Now, when the sixes were successful, You saw instances where it gained 1.8, 1.98, 5.17%, 2.61, 2.70, 2. So right now, the way the market has acted off those highs is very consistent with successful signals. Got it? It's only it hasn't really moved. Now, secondly, let's see. We're now 37 days past the signal. At yesterday's close, we were 37 days past the signal. How has the S&P done? Now, S&P hasn't collapsed. It's only down 1.49% since December 11th. But let me show you something. In the year 2000, the signal on June 12th, the market was up 0.45% 37 days later, yet it had a total decline off the signal of 23.70%. In 2001...
Oh, it was just later. It was just later. 58 days later.
Right. The signal was later. But the point is the market held up just as it's held up now, or it's held up then as well. Secondly, in here, it was up 0.31% in 2001, but from the date of the signal, the ultimate decline was 32%. And then again in 2015, it was up 1.07% by day 37, but its ultimate decline was 13%. And again in 2021, it was up 0.36% through day 37, and its ultimate decline is 21%. So therefore, I tell my clients, yes, we're short since December 11th. Yes, the market hasn't gone down. However, the market hasn't gone up. It's only gone up 1.12% maximum. And looking at the instances in the past where the signal would work, by day 37, in many instances, it was up. We're down 1.49%. So my recommendation to the institutions, now they don't all follow me. They just use me as an input, obviously. The people managing billions and trillions of dollars, I'm just one input. Hopefully, I'll be one of the best inputs, but I'm just one input. But in any event, based on this successful short signal, we should still be short. Now, it might change at today's close for all I know, right? But based on this successful short signal in the past, let's face it, we're only up 1.12% since December 11th in the S&P. And at yesterday's close, we were down 1.49, which is totally consistent with previous successful signals. This is the one reason I went short. Nothing to do with the Fed, nothing to do with Trump, nothing to do with moving averages. Simple and indicated that it doesn't have a perfect record, but it works great at calling market peaks and bull and bear market rally peaks. And since we had no new buy signals since May, and we had one buy signal in June, which is, I'll get to it maybe later, which is a weak buy signal, we're giving you the benefit of the doubt to the short side. However, I would tell you, a retail investor who's following my work would sit through a correction of 4, 5, 6, even 7%, and not get out. And because we're very long-term oriented. For institutions, we're trading oriented. We can go short, we can go long, we can go leverage. It's a totally different ball game. And this is the reason we got short, just because of this one signal. Of course, in the back of my mind, I know there's a recession indicator that has 100% record that's now in a sell, which is the rate of change of the unemployment rate. That's suggesting recession. I know the leading indicators are still suggesting recession. And maybe there'll be recession, maybe there'll be depression, maybe there'll be great deflation, maybe there'll be inflation. We don't really care. We just care about the indicators. And in the back of my mind, I know if you're going to get a major bear market, there'll be some sort of event that we probably can't even predict that's going to be associated with that bear market.
I think I already asked you this, Milton, but it was the move in the NASDAQ VIX, VXN, was it a decline or an increase?
You asked me before. It's actually a decline. It signals out after rally. It's actually a decline. I'm sorry. It's a sharp decline. Let's say it's 5 days, but it's not 5 days. Let's say it's 5 days relative to 30 days or relative to 20 days. It's not 50, 30. It's not 20. You want to see a sharp decline in VIX relative to the rate of change for a longer period. And it's basically people. How it works. It's inclusive. The 5 days include the 30 days. You see, It's not 5 days and the previous 25 days. It's 5 days and 30 days, including these 5 days, which has to be a greater extreme.
I see. So it's people. It's investors who were hedged, bidding up options on. They got rid of their hedges too quickly.
They're very optimistic of the market on a very short-term basis, showing up in these numbers. Right? Exactly. It's a shift in expected volatility, which is a shift in bullishness, which doesn't always show up in the institutional. In the retail newsletter followers, doesn't always show up necessarily in put call ratios, but it shows up in this indicator precisely near market peaks.
Yes, almost never. And was it two coincidence things, this VXN thing happening and something else, or was just this?
No, this is one indicator based on VXN itself. One indicator. They say it doesn't have a perfect record.
Yeah, this is special because most of the times people see implied volatility falling or even crashing, and they see that as a giant buying opportunity. For you, it
Yes.
makes you nervous. That's very
No,
interesting.
no. Context, Jack.
Yeah.
If this would have signaled on June 15th, I would have. It didn't, but if it did, I would have ignored it because you're just coming right off a major low with major buy signals.
Mm-hmm.
Since it's signaling in December after the market's been up since April, and since I got no additional confirming buy signals, that's when I will try to act on this. In other words, when I tell you the signal is not always perfect, and I mentioned that in bull markets you're going to get false signals, I'm aware of that. I'm not going to, during the bull market, I'm not going to have 4 false signals that I'm going to follow. I'm going to follow signals in which the market has already gained significantly and there's no confirming buy signals.
That makes sense. And so to me, you're normally, Milton, you get an overwhelming constellation. It's like a parade of buy signals or sell signals that motivate you. Just let me finish. That motivate you to establish a position. It's interesting, me, Milton, and maybe I won't, without your permission, disclose just exactly how short you are in your model portfolio, but I can tell our audience very, very, very short. It's interesting to me that it indicates why you have such a large short position given this one reading. Yeah.
Well, there's more. There's other things that I talk about, but we went short on December 11th. We added short subsequently based on other things. I just want to show you.
Okay.
We were long into December 11th. We went short on December 11th. I'm trying to show you why, really. But I want to tell you one other thing, and I don't know, most technicians won't admit to this. Many will, but many won't. It is so much easier to call a market bottom, technically, than to call a market peak. Okay? Yet, technicians are always afraid to call a market bottom, and they're never afraid to call the market peak. That's if they're so wrong at the top, and they're so wrong at the bottom. It's so amazing. In other words, it's easier to call bottoms, but everyone's always afraid to call the bottom. But it's so much easier, technically. Calling a top is very, very difficult for everybody because top it's in stocks, not necessarily in commodities. Commodities are easy, but stocks have rounded tops, and there's always groups that are doing well even when the market's peaking. So stocks are much more difficult. And it's funnily enough, everyone's out there. You see people you interview all calling for market crashes, calling it for 6 months, 8 months, 9 months, 10 years in a row. You understand? Somehow they find it easy to call for market crashes. It's very difficult to call market bottoms, even though market bottoms are so much easier to call and market tops are much more difficult to call.
Sophisticated investors don't typically park their cash in high-yield savings accounts. Instead, when they want yield, they turn to one of the fastest-growing asset classes for institutional investors, private credit. These private credit strategies were once reserved exclusively for wealthy institutional investors, but now they're available to investors of all sizes thanks to the Fundrise Income Fund, which has more than $600 million invested and a 7.97% distribution rate. With most traditional savings yields falling, it's no wonder why sophisticated institutional and individual investors are turning to higher yielding asset classes like private credit. Click the link in the description or visit fundrise.com/mm to invest in the Fundrise Income Fund in just minutes. The fund's total return in 2025 was 8%, and the average annual total return since inception is 7.8%. Past performance does not guarantee future results. Current distribution rate as of 12/31/2025. Carefully consider the investment material before investing, including objectives, risks, charges, and expenses. This and other information can be found in the Income Fund's prospectus at fundrise.com/income. This is a paid advertisement. Back to the interview.
Okay. You want to talk Bitcoin or more about stocks? I could talk about, because I have a lot more about stocks.
Let's tease the people a little bit. Let's let them wait. Let's talk more about stocks. We will get into Bitcoin. We will get into gold. We will get into silver. But yeah, what were the other signals you saw since December 11th?
Let me show you something here. We actually, let me do this, Control L. If you can't see the screen, let me know.
I will.
Russell 2000. We called this. I actually sent out the email at 4:01. I started writing it at 10 minutes to 4 on January 23rd, day after the top, at the close. This is the Russell 2000. This is a chart. You can see where I'm circling here, the circle?
Yes.
You see this island reversal. Island reversal means it gapped into the update and it gapped down. You can make it a little island. This bar on the top is an island, you see? You see what I mean by island?
Milton, can you explain what this means and what it indicates?
I'll tell you what it means. When the market gaps to the up, now some people don't understand what a gap is. A gap doesn't mean the market opened higher than yesterday's close. That's not a gap. A gap means it opened higher than yesterday's high, and a downside gap means it opened lower than yesterday's low. And for a gap to be valid, it has to trade the whole day with the gap not being filled. So in other words, if the market is up on a day and it opens higher than the day's previous high, and by the end of the day it remained higher than it always remained higher than the day's previous high, that's an upside gap. A downside gap is just the opposite. The market opens below the previous day's low, And throughout the day, it remained, its highest high of the day was below the previous day's previous low. Okay, that's a gap. A gap basically is telling you there's an emotional move. That's what a gap is supposed to tell you. It's an emotional move in the market. It's very, very rare. I mean, in some markets, it's more rare than other markets, but it's very rare to see a market gap at all. I'll show you some markets that almost never gap. But there's something called an island reversal, which is just two gaps. One gap that takes place on the way up, another gap that takes on the way down, and you could make an island. There's an air pocket between those two gaps. Now, I showed you this one, but this is a unique gap. It's the only time it ever happened in the history of the Russell 2000. What does that mean? It's a one-day island. I call it an isolated one-day island reversal at the top. The Russell 2000 was really, really very, very lethargic for quite a number of years, as you know, right? Yes. All of a sudden in January, people are saying the market is broadening. The market is broadening. Wow, look, the small caps are moving, right? Everyone was saying it. Even the bears were saying it. Oh, you know, the AI is going to go down, but the Russell is going to continue higher. There's a shift in rotation, right? And people believed it so much to an extent that on January 22nd, the day of the final high so far in the Russell, the market gapped up. But that's only half the story. The next day, the market gapped down and it created a one-day island reversal, one day.
And that's never happened before, ever?
Never in the Russell 2000. Usually an island reversal have 3 days or 6 days. I'll show you the history. I went through every island reversal in the history of the Russell. Got it? So I'm not just talking out of my hat.
I know you're not talking out your hat. Yeah, Russell 2000 is the U.S. small caps.
Russell 2000 had an island reversal. I immediately said the Russell 2000 is giving a very, very bearish signal. So we had the sell signal on December 11th in the S&P. The S&P only was up maximum of 1.12% above its high actually by January 22nd, it wasn't even up 1.12% because it peaked on January 27th. But anyway, this is another reason to suggest the market might be topping. And in fact, the Russell 2000 ultimately through yesterday's close were down, I think 7% off its high. What am I showing you? This is an island reversal gap is negative. I looked at previous tops that occurred with now you see you have a gap up right off the lows in April. You see, you have a gap up in May. You have a gap up in June. You ignore these gaps because the market's coming off a thrust low. You don't, just like we don't look at the VXN sell signal right off the low, because of course the VXN is going to collapse right off the low. So too, there'll be a lot of enthusiasm when the market is coming off a low. But we're looking at this where everyone's so excited about the Russell, claiming that it's starting to break out, claiming it's seeing a broadening, and that's when you see a island reversal means it gaps up, gaps down, and then it continues lower. Now, we wrote our report the day it gapped down. Now, of course, it continued lower until yesterday's close. So this is showing early in the move. You see multiple gaps, which are considered buy signals. See, context is the key in many indicators. Gaps are not random. Gaps take place off lows and gaps take place into tops. You have to know where you are, where you potentially are. This is July 17th, 2000. This, again, it wasn't an island reversal. It was 2 gap days in a row off the high, 2 gap downs. And that marked the top of the market. The market tested, never made a higher high. And then it declined some 40% over the next 2 years from July 17, 2000 to the bottom of the bear market. You saw over here again in September 19, 2008. Now realize
Lehman.
There was a financial crisis. and for some reason on that day, there was some positive news out of the Fed. And the Russell 2000 gained 19.85% on the day.
Milton, only because I'm a giant nerd and I've read a lot of books about 2008. I think that was, you're a technician, not that you think it doesn't matter.
I lived through it, but I remember what the market did, but I forget what the news.
There was a stimulus bill that I think was going to go through Congress, and then it didn't pass, and it was
okay. Yeah. So it was up 19% intraday, 9.85%, gapped up to the top, and then it declined 60% to its final low, and this is a continuation gap. So I'm pointing out where you see important gaps at previous peaks. Now look at this one. This is on January 17th, 2020. You remember the COVID crisis? I think so, right? COVID crisis?
Yep.
Now, the COVID crisis didn't really begin until early March. But the Russell knew about the COVID crisis because the Russell gapped up one day before its peak. One day before the all-time high in the Russell 2000, on January 17th, 2020, the Russell gapped up. That was its high. Then it further gaps into the secondary high. But this is, again, a sign of a market peak. Uncalled for enthusiasm at a new high. Got it?
Mm-hmm.
In that case, the market declined another 43.90% to its low. And I show 2007, a various gap. I don't want to take too much time on this. I just want to justify why I'm able to, going through history of gaps. I mean, the only other, see, this is our island reversal. This is our current market. See the one I showed you earlier? January 22nd, 2016, right? The peak on November 15th, 2024, the final peak in that rally was also on a gap day. You see? Then the market declined 29.90%. To find an island reversal in the Russell, the raw island reversal, let me see if I think I highlighted an island reversal here. No, this is not a true island reversal, no. I think I highlighted one, but I don't take too much time in it now. But the one-day island reversal we had now, which I called it an isolated one-day island reversal at the top, has never before occurred in the Russell. It occurs in commodities often enough, has never occurred in the Russell. And the reason it occurred this time is because everyone's so enthusiastic about the Russell, rather than understanding, and I wrote this in my reports, rather than understanding that in nearly every bull market in history, it peaks when the laggards start moving. It doesn't peak when the previous movers start moving. It peaks when the laggards start moving, and they call it the generals and the troops. The generals slow down, and they let the troops get killed. You understand?
And I'm sorry, are the laggards? Would they be high beta, high risk, high speculation stocks, or are they safe stocks like Coca-Cola?
Every market has a different laggard. Yeah, sometimes it's low beta like Coca-Cola. Sometimes it's the small caps like the Russell 2000. In this case, the Russell 2000, the SP 600 did very little for the last 4 years. And all of a sudden, it starts surging into a peak. And everyone's claiming bullish, bullish, bullish. Market breadth is increasing, and the market is broadening, and get out of your AI and just buy the small caps. And I say, no, it happens. It's so typical at the top of a bull market, where they call it the dogs, right? The dogs start more. There's an expression. Something about the dogs lead the pack, you know. Right?
Yeah.
So yeah, these are the dogs. The S&P, I think 40% of the Russell 2000 have no earnings, or negative earnings. So this is not a quality indicator. You call it small cap, whatever. They're great small caps, and they're garbage small caps. And the Russell 2000, about 40% of it are small caps that have really no earnings. I just wanted to point out what we saw, which is this amazing. One day, it's another reason to be bearish. Again, there's another reason in the back of my head why I didn't use yesterday's action to cover my shorts, even though there's some historical instances. My models didn't go long. I just gave instances where it might be a bottom. I'm still, tops are very difficult to call, and bottoms are difficult to call. And this bottom, after 2.5% decline in the S&P, less than 3%, it's highly unlikely that it's a bottom. Maybe it would be a sharp short correction that ends. We'll see. I'm trying to tell you that I'm not pounding the table. I'm not sure. I'm trying to show you what we tell our clients. We don't every day have a strong opinion like most people try to do. A strong opinion is that we're in a bull market that began in April, and the market should continue higher. It's projected to go higher unless we see something different. We haven't seen anything major different except the VXN sell signal in December, and these things like, for example, this gap up in the Russell 2000. Let's see. Let me show you the last buy signal we ever got, if that's interesting to you.
Absolutely.
I said the last signal we got was on August 13th.
But you said you didn't like it.
I don't like it. I'll tell you why. This signal occurs when the Russell declines at least 5%. Bottom 8 days ago, meaning it didn't make a lower low for 8 days. So on August, its first signal on April 9th, 2009, but the latest signal was August 13th, 2025. In that case, the Russell was down like 5.5%. SP was down like less than 2%. The rest of the market didn't pull back. The Russell pulled back, held its low for 8 days, and on the 8th day, it exhibited an upside gap. Remember we said upside gaps are great after a low, and the bearish when after market has an extended rally. Mm-hmm. This is one of the cases where you get an upside gap just 8 days after a low. Now the low was only 5%. In most of these instances, it wasn't just the Russell down 5%. Many other indices were down. In this case, only the Russell was down 5%. Even the SP 600 small cap wasn't down 5%. And on the day 8, it gapped to the upside. Let me just show you the history of this one. This is it's signaled on April 9th, 2009, right after a major bear market down. It was a 56% bear market. It was right. It signaled on October 14th, 2000, also early in a bull market. It signaled on September 3rd, 2010, after a 19% decline in the S&P. The signal on 2012. This is more of after a rally, but you did have a great low in 2011 at the lows. It signaled here. It signaled during an up move in 2017. Here it signaled after the 220 lows at the June correction, and now it's signaled here. Now, when I saw the signal, I think it's a weak signal, but basically the S&P is up 7.9% since then, which is not a bad move. Why do I say it's not a bad move? It's only up 7.9% since August 13th. Because I look at the history of the other successful moves. You see right here, this is a table. This shows all those 9 instances when we got the same signal. The 90, I'm showing
Oh,
the 90.
so you're looking at the results for the S&P, even though the signal was for the Russell.
Yes. I showed my clients the signals for the Russell, but I trade basically the models that built to call the S&P. Okay,
Yep,
we're
yep.
looking at, okay, that's the point. But the point over here is that through 90 days, the maximum gain was 6.72, which seems pretty weak, right?
Mm-hmm.
However, in 2016, the maximum gain through 90 is only 2.83% and went on to gain 15%, you see. In 2012, by day 90, through 90 days, it was only up 5.38%, and yet it gained a total of 22% within a year. In 2009, it was up 5.33% through day 90 and ended up at 11.47. So the fact that we're only up 6.72% is not really troubling. But this doesn't go into my models. It's not robust enough as far as I'm concerned. So I say I built models to call markets, which we'll talk about for retail and so on. This doesn't go into my model. This is something that I show my clients just to show what's going on in the market. I did not put much weight into this particular signal, but we're on a buy signal off the lows anyway. But I didn't put much weight into the signal because you're looking for a gap up after a decline, and only the Russell decline. It was only a minor decline of 5%. And in Russell, 5% decline is really just a hiccup. It's just a random event. Russell is far more volatile than the S&P. So that's that one, okay? Now there's something else here. This is very important.
Mm-hmm.
This is very important because you would think that I just show some signals with some data. You think I wouldn't even follow the standard technical stuff, but I actually, believe it or not, I actually follow standard technical stuff as well.
I know, Milton, I was looking at some of the data and all the materials you sent. Almost all the time, you have very few charts, all tables and data. But this time I said, Milton, making charts. What's going on?
These charts are just reflecting where the data is. But anyway, let me show you this. We looked at every great market peak since 1966. Okay, every market top in the S&P. We're looking for a minimum decline of 18% in the S&P. So, for example, 1966 market peaked on February 9th and declined 22%. Let's see, 1981, the S&P peaked on. They're actually looking at the Dow peaked in April 27th, declined 24%. Nasdaq peaked in May 29th, declined 28%, and so on. 87, S&P peaked on August 25th, declined 33%. You see, we're looking for every decline of at least 18%. In 2000, the S&P peaked on March 24th, down 49%. Nasdaq peaked on March 10th, down 77%, and so on and so forth.
And Milton, these aren't just highs. They're highs that specifically were the peak leading to
the final highs in the market.
Final highs, not just highs.
Final highs in the market. The final highs in the market for a decline of 18%. Final highs. Okay?
Because most of the time, most of the time highs are actually bullish, right?
Well, until it's bearish, yeah. Most of the highs are bullish until it's bearish, right? But yeah, because the market makes a series of higher highs till its final high. I mean, market can make 50 higher highs till its final high. So yes, if you look at it that way, of course, highs are generally bullish. The question is what takes place at the highs. So for example, I'll give you. I highlighted with little red arrows. There are 4 pages, by the way. Okay, of data.
Yep.
I highlighted like the 10-day trend. Now, I hate explaining what trend is because it's even I've always found it difficult to understand it. Now I finally understand.
Milton, I prepared. I looked it up before. It's ratio of upside volume to ratio of downside volume.
No, that's only half the ratio. It's the ratio of upside down to downside volume to the ratio of upside stocks to downside stocks. It's a ratio of a ratio. In other words, it's not enough to have high upside volume. You have to have high upside volume relative to the number of stocks that went up. So, for example, if you have 10 to 1 upside volume and you have 10 times as many stocks up as down, the trend will be 1, neutral. However, if you had 10 times to 1 upside volume and only had a 1-to-1 ratio of up stocks to down stocks, you see, then the trend will be 0.50. That will be a very, very low ratio because the upside volume is overwhelming to such an extent that it takes the ratio down. But in any event, I don't want to get into the trend because I'll have to get into everything and it's going to take too long. But the 10-day trend in the NASDAQ at the day of the peak of January 27th of the S&P was 0.76. Now, that's exactly the median you see at previous market peaks. It's 0.78, you see? But right at what you normally see at a market. Now, I'm sure all 4 pages are all yellow. When they're red, when any column is red, it means it's not consistent with what you've seen in the previous market peak. Everything is consistent, but many of them are at the medians. For example, 25-day New York Stock Exchange trend at 0.98, the median is 0.96, you see? Mm-hmm. Let's look at this one. 10-day advanced declines in the NASDAQ. The New York Stock Exchange is 1.07 over 1. The median at major peaks is 1.09 over 1. We're at the median. What about the number of 52-week highs in the S&P? On January 27th, they're 45, which seems like a high number. But in fact, the median peak at final market peaks is 47, right there. And I can go on and on and on. Let me find an interesting one. Let's look at rates of change, because that's really important. Let's look at the 6-month rate of change in the S&P. You know, the S&P has only gained 9.22% over the last six months, even though it's up 37% since April. It's slowed down. The median is 10.08% at the top. Let's look at the NASDAQ. You know, the NASDAQ is only up 12.46% over the last 6 months, even though it's up 45% off the lows. But the median at a peak is 13.19. Let's look at the smaller caps, because we're all talking about small caps. The S&P 400, which is mid cap, its 6-month rate of change is 8.5%, but the median is 10.94. It's below the median gain. It's weaker than you'd expect at the top. You see? So these are.
And tell me about threshold and what that means.
Threshold means if it be above this level, it would turn red. If the 6-month rate of change of the NASDAQ would be above 81.11, it's totally inconsistent with what you see at a market peak. You've never seen that strength at a market peak. Well, let's look at the number of highs in the S&P, because that actually helped me out in 2023. Let me show you that. If S&P, it's page 1, 52-week highs. The threshold is 87. There's a period during 2024 where most of these things were yellow, but the number of highs were about 92.
I think you may have talked to me about that, Milton. Yeah.
Which told me that that's not the market. Generally, you wouldn't expect that to be the market peak, because you never saw a market peak with that many new highs. Okay? Just showing you something else we look at.
You just went through a lot of the data, but I didn't hear a lot of conclusions. What were some of the conclusions?
Well, this conclusion here is, if anyone's telling you that the market action is inconsistent with actions seen at previous market peaks, or if anyone tells you that Federal Reserve action is inconsistent with what we've seen in the previous market peaks, or if anyone tells you that the rate of change of interest rates of the long bond is inconsistent with what you've seen at market peaks, I would show them my technicals at the high and show all of these things are in my table, and all these things are consistent with what you've seen at prior market peaks.
You're saying that you're seeing signs of market.
I'm saying that no one can argue that the market can't peak now based on technical data. They can argue that we're not at a peak, but they can't argue that we can't peak. In other words, sometimes, very often, half this data is red, meaning the market is showing signs that it's not peaking.
And red in this instance is good. In the same way, red in China means stock market goes up.
Red means that it's not consistent with what you've seen at previous peaks. I mean, a good example would be the 5-day breath. Like, for example, let's get the 5-day breath. 5-day advanced declines, you see? It's at 1.33. If it's above 2.3, 2.34, you're not going to see a market peak. It's going to be a thrust. Only once did you see it above 2. That's back in 1976. Now, 1976, just to let you know, was one of the strangest markets, because the S&P peaked, the Dow peaked, they declined about 18%. At the same time, the American Stock Exchange, which I don't think exists anymore, which was the small cap index of the day, was in a major bull market, gaining 30%. It was mainly in oil stocks, but the oil stocks in the S&P were also rallying while the S&P was declining. So therefore, at the peak, you saw the oil stock surging, and you saw a 2.34 to 1 AD line at the peak. But generally, you see at the peak, the AD line is look at it. You never see it even above 1.75. We're at 1.33. Median is 1.18. But you had 1.66 at 2011 top, also difficult top. But 1.58, 1.52, and 89 and 90. Okay, so this is just one example. 5-day advanced decline line. We have a 5-day AD line we use as a breath thrust. We have readings of 3, 4, 5 to 1 on over a 5-day basis, which gives us buy signals. But to tell you can't expect the market to peak, even at a 2 to 1 level. You wouldn't expect the market to peak. We're not there now. You understand? Mm-hmm. If you had 90 new 52-week highs in the S&P when you last saw the high, and this only looks at the days of highs. So if January 27th could have been the final high because the data is consistent, it doesn't mean that it is the final high. It means it could be the final high. And we look at, as you can see, we look at many things. We don't just hang our hat on one indicator.
Yes.
Okay. Let's see what else you want to. You tell me what you want to talk about. Many things to talk about.
Milton, we'll return to stocks, and we will. I promise our audience just get into the commodities, gold, silver, maybe a little oil, but also particularly Bitcoin. But Milton, I just want to take a lot of the work that you've been showing is for institutional clients, some of the biggest and most successful hedge funds in the world. You recently launched a product that is for individual investors. I include myself in that category. Yeah. What is different about this product, tell us a little bit about the value that you think it could provide.
Okay, I'm going to take it step by step. But basically, before I even show any charts or show any data, individual investors find it very, very difficult because they read the news and they hear the news and they try to follow financial reports and even listen to great podcasts like Jack Farley's great podcast. They always get conflicting opinions. They don't know what to decide for themselves. They're out of the market when the market's rallying. They get into the market close to the top. It's very difficult for an individual investor. And I wanted to create, I spent 10 years working on models. I really didn't plan to build a newsletter for retail investors. I really just originally wanted to write a book. And when I remember, as I did my research was getting so robust and it fascinated me because I couldn't believe what I was discovering in the market, to be honest with you. If 10 years ago, someone would have told me by the time you finish, you're going to have 2,800 indicators. You're going to have about 600 indicators that have a perfect track record, meaning without a pullback on a buy signal, with pullbacks of less than 3.5%, I wouldn't have believed it's even possible. Most indicators work on percentage. It works 65% of the time you're happy. It works 75% of the time you're ecstatic. There are indicators that work historically 100% of the time, and they're not made-up indicators, they're not backfitted indicators. We're just looking for rare data that takes place at lows. The problem is most people who look at market lows only see what's obvious to them. They open the chart, they see a moving average. There are many, many indicators, as I mentioned earlier, they're not obvious to the most people, not even obvious to most technicians, because they don't follow it on. It's not computerized. Just as long as we're talking, I have one of my spreadsheets open. So here you see, for example, this is today's spreadsheet that I get my indicators on.
Oh wow!
So for example, today I saw the VXN. Yesterday VXN was up 10% over 2 days. VXN was 35% in 3 days. These indexes had the highest 3-day volume in 200 days, 200 days, 20. I get these indicators. These are not signals. These are just basic indicators. Yes. But I want to point out, I'll go to the column where you show no signal. You see a column says no signal right here?
Yep.
You see that? No signal? Just want to show you how many indicators we have. So you go to no signal.
17,000, 19,000, 20,000.
We'll be this soon. You see, we have 22,300 indicators that have not signaled today.
You have 23,000 that did not signal.
22,309. No, it's actually 20,310 that have not signaled today. Right. Okay. Right. So the point is, we're looking for these things to signal. We're looking for rare signals. We're not looking for the kind of things people look at every day. Markets up 1%, markets up 2%. We're looking for things that don't take place too often, but when they do take place, they're telling you something. Got it? So sometimes the VXN getting 35% in 3 days tells you something, as I pointed out. But sometimes it's not sufficient. That's why we're not ready to cover our shorts today. But on the other hand, by tomorrow, today's action may change things. It's a very, very big bullish day. Okay, let's get let's go back to the retail letter. So I wanted to create something for retail people. I wanted to create something. When I say I wanted to create something, I was only able to create it after I did all my work. I realized that the data I'm getting allows me to create something that retail investors never had before. And that is, we're told that if you miss the greatest days of the market, only 5 days a year, you'll.
Yep.
Right. So if you're going to try to time the market, it's likely you're going to miss those great days. You know why? Not because by chance you'll miss those 5 great days. Because those 5 great days generally take place early on in a bull market. They don't take place middle of a bull market. Like the 9% gain you had on April 9th was early in a bull market, right? See that? Mm-hmm. So most often the great gains take place early in a move. If you don't get it early, you wait for the moving averages to cross. You wait until the Fed eases 15 times. You're late and you miss the great move. So, on the other hand, I realized in doing my work that it's difficult to call tops. In other words, as they say, the recession indicator called 18 of the last 6 bull markets. In other words, tops are more difficult to call. So this is what I did. It's different. We decided we're not going to call market tops at all. We're going to be long the market until it declines. For the model purpose, I used 8%, but in talking purposes, I say 7 or 8%. But for the data you're going to see is all based on a decline of a minimum of 8%. Okay, so we said like this. We're going to buy the first buy signal that's generated. Now, the institutions see our hundreds of signals. We're charging our retail people $10 a month. Institutions pay as much as $12,000 a month. So we're not gonna give the data away. But we're going to give the retail indicators a buy signal at a first new buy signal after they're out of the market. So So what gets them out of the market? Say they got a buy signal on April 4th, they'd still be long because the market has never declined 8%, right? The maximum decline was 5% and change a few days after the low. So we're going to say you're going to buy the market, hold on, and you're going to hold on until we get you out. We're going to get you out after about a decline of about 8%, which is the model. Why 8%? Very simply. An investor can tolerate an 8% decline if he's already made 30% on the up move, number one. Secondly, he can tolerate 8% decline if the market's going to decline 44% or 35% or 26% or 19%. He's happy to have missed the bulk of the down move, even though he caught the first 8% of the down move. Got it? Number one, we had roughly 55 buy signals since 1957. Remember, I'm only showing you the initial buy signal after we're out of the market. I'm not showing institutional wise, there's thousands of buy signals. For the retail model, we have a buy signal. We had about 55, it says 55 buys and sells since 1957, you see? And this is a chart showing all the buys. The last buy I highlighted April 4th, 2025. The market's up 38% since then, right? Since April 4th. Now, these are the buys, and they're based on signals, which I'll show you some of the signals. However, what are the sells? When do you get out? So you're going to get out? We don't know what the sells. We're not smart enough to call the sells because sells are very difficult. Tops are difficult to call. We're not going to anticipate a bear market. We're not going to say get out now at the tie of the market because it's a bear market. You're going to say, you know, my clients, you know, my retail clients, you know, my individual investors who don't have time to sit at a computer all day and watch the market. They'd rather be retired. They'd rather build a retirement account and work in their shops or work in their on their computers or whatever they do, and rather not watch the market. We'll tell you to get out when the market's down some 8%. And then you'll just go into treasury bills, which is a great safe investment, okay? And we'll tell you when to get back in, when we get a buy signal. And now what is that done?
So Milton, to be clear, there is one and only one sell signal. The market's down 7 or 8%. That's it?
For the model purposes, what I'm showing you now is based on 8% at a closing basis. Mm-hmm. In reality, it's 7 to 8%.
Yeah.
I'm not the first one to use 7 to 8%. William O'Neill, as you know, in his famous Can Slim model, tells you buy a stock and get out if it's down 7 or 8%. So I use that term, but the model was built using 8%, to be honest. Each of these cells you're going to see was down 8%. Let's go to the next page because this is good. This is all the buy dates. Let's see what you did if you got out down 8%. Now somebody's going to be down 10% because the market will be down 3% in one day.
Yeah.
This is the batting averages. In other words, the model starts on the first buy signal occurs on October 21st, 1957, was the day before the low. The market gained 51.26% before you got out. You got out on September 21st, 59, and you average the average long position getting in to get out. You gained 26%. The average decline when you got out of the loss was 1.41%. $10,000 invested in 1957. Following this model, it'd be worth $1,102,000 at the end close of trading yesterday. January 6th.
10 billion? How is that possible? Wait.
Compounding 8.5% per annum. Try it out. 50, 70 years, 68 years.
You started with 10,000?
18.5% per annum, starting at 10,000, 68 years. You'll see.
Wow.
It's $1 billion. Okay, that's it. So the point is though that you're a long-term investor in the S&P 500. You're not going to pick stocks. You're not going to pick sectors. You're not going to worry about bear markets. You're going to be long. You're going to capitalize on most of the big moves in the S&P 500. You're going to wait till the market's down so much before you get out. And if you're in a retirement account, you're not going to pay taxes. And this has been the return. Wow. Yet the profitable long trade, 95% of the long trades have been profitable. I'll give you an example. You bought on August 4th. Let's say the market's down 10% tomorrow. So we're down 8% off the highs. It's a profitable trade. You bought on August 4th. You're not going to be up 40%. You'll be up 29%. Got it?
Yep, and Milton, so 18.5%. That is pretty good. Buffett, I think, is 20 around 20%.
Great, but it certainly outperforms most hedge funds. I mean, it doesn't outperform Stanley Druckenmiller or George Soros, but it certainly outperforms 90% of hedge funds. No question.
Yep, and Milton, the fact that you're never on the when the market's going up, you're never outperforming by having a beta or exposure over 100%. So it means it's just avoiding drawdowns, and then what that indicates to me, I think it must be a logical conclusion, is that the worst periods for the S&P 500 are when it's already down more than 8% from its highs.
It's amazing that you asked. Look at this. This is the year-over-year returns based on the model. Yellow are the years the S&P were down. So In the year 2000, let's go back here. In 62, the SP was down 8%. The model gained 18%. In 66, the SP was down 10%. The model was flat in the year. In 74, the SP was down 26. The model was up 20. Why? Because we're out during the bulk of the decline, and we get in within days of the low, and we catch those big 5-day moves that people are afraid of missing. You see, 81, the market's down 5, we're up 15. The last was 2022. The market was down 18.19%. We're up 3.6%. Again, this is total return. It's including the dividends on the S&P, and it's including the income you get from treasury bills. Now, okay, so this is just showing the yearly returns. Any question? Pick a year, like any year.
And you don't get the advanced signals, but you just get this reading of the S&P 500, when to get in, when to get out, and your model has been long the S&P throughout all of this turmoil since early April. And I think, Milton, that is so important because it's not just the quality of the research. I mean, as people can tell, you have a pretty encyclopedic read of the markets and market history, but it's also how accessible is it to the person using that research? Like, for example, I mean, there are some great research providers out there, or good research providers, who the thing is so complicated that it's almost impossible for someone who's not trading the markets full time to implement it. And actually, there is a risk for very smart people who are very proficient and successful in their fields, but are not experts in the markets to get things wrong. And so I think the simplicity of this model is extremely important.
Totally. And people try to scale in and scale out. They never show. Here's sure. You're either long or short, or either longer asset or T-bills. Nothing wrong with being in T-bills, right? Mm-hmm. And nothing wrong with being in a bull market and getting out after you're down 8%. You have a tremendous trade, doing far better than most people. Now, let me show you something else that's fascinating about this. People who have a business or they're working, they don't want to trade all the time. We have an average of one trade, one round trip buy and sell every 1.25 years.
Wow.
2026, there were no trades. In 2025, we sold on March 10th, and we bought on April 4th. 2024, 0 trades. 23, 2 trades, you see. The worst we saw was in 2002, there were 6 trades. Worst. That's the worst we saw, you see. Mm-hmm. So this is also, look how many zeros there are. I mean, you can sit back and just go on your vacation.
That's amazing. And people say, I want as many signals as possible. And people can tell, you have 20,000, probably more signals. But really what people should be paying for is the lack of signals, the lack of...
Exactly.
You do nothing. Okay, so Milton, you charge a quite hefty fee for your institutional investors. Yes. But you said that this is only $10 a month. So is that $120 a year?
Yeah, this is our website. For institutions is miltonberg.com. Individuals is miltonbergedge.com. And what I did is just, I showed you 2025. I just did select 6 dates, sample dates, if you're interested, to show you why it was so difficult to get into the market and why the model told you to get in. So, for example, October 21st, 1957, Secretary of Treasury Humphrey, he was the Secretary of the Treasury. He said we're headed for a depression, as did former President Herbert Hoover, who was still alive in 1957. And they both were warning of a Great Depression again. What do you say to that? 1957. And comes Milton Berg's model and gets a buy signal. On October 21st, 1957, what was the buy signal? Simple stuff. The 5-day average volume of New York Stock Exchange was the greatest in 375 days over the past regime of high volume. The S&P 500 made at least 60 new 1-year lows. The S&P 500 closed at least a 60-day low. The S&P declined at least 12% into today's low, and today was the lowest low off its high. And net upside volume as a percentage of total volume, I don't know, it's complicated, was below minus 0.45%, which means heavy downside volume. And you had a reverse breadth thrust. Advance of declines was 0.0. In other words, the opposite of an advanced decline line, a reverse advanced decline line. And this signaled at the low, just when everyone's expecting a Great Depression, it signaled at the low, market gained 55%. Signal again at the low in 62, market gained 79%. Signal again.
Right. Milton, sorry, I just don't want to get lost in I want us to go to the weeds about the present day. So people go to those websites. We'll include those links in the description. Milton, let's talk about Bitcoin, gold, and silver. Let's starting with gold and silver. We've had such a powerful move over the past year higher, and yet we just had an utter collapse exactly 1 week ago. I've been receiving your research, and I was impressed that either the day of the high or the day after the high, you correct me, you actually you put a short position in gold and silver by selling
Yeah.
call spreads. What
Yeah.
did you see in gold and silver? What have you made of the market action over the past week?
Okay, it's so funny because look what page you just opened to. You ever hear Nelson Bunker Hunt? You ever hear these people? You ever hear
Yep.
Bunker Hunt? That was the last silver crisis. Not this, the last one you had, but silver went traded to $50.
Silver Thursday.
This is back. Look at that. So guess what? The market declined. I want to show you this, and this is March 24th, 1980. Nelson Bunker Hunt, 71% silver collapse. And the CPI was at 14.7% on that month, the highest in 23 years, on March 24th, 1980. And the market was down 17%, and everyone's panicking. And guess what? We got a buy signal. I'm not going to get into it now. Just trust us. We got a buy signal.
And that was a buy signal for the S&P. But yeah, I'm asking.
No, the point I'm making is the panic in silver generated a buy signal in the S&P. That's what I'm trying to point out. Let's get back to your questions of gold and silver. It's just interesting that you mentioned silver. Just when I had the chart about the Nelson Bunker Hunt silver panic. Let's talk about gold and silver. Okay, number one, I got to show you why we do a lot. I manage a lot. People don't know this. I managed the largest gold fund in America in the 1980s, largest gold stock fund.
Yep.
You saw that picture up there where it says mutual manager of the year. I managed the 3 top funds of the year in '87. One of them was a gold fund, and the reason was because while everyone thought gold will go counter to the market, my argument was I saw a crash coming. I said gold is moving up along with stocks. If gold moves up along with stocks and the stocks are going to crash, no reason for gold to go counter. Gold will go counter if it's showing signs of going counter to the market. But if gold and stocks move in the same direction, there's no reason to believe that when stocks go down, gold will continue going up. So we lowered our cash position in our gold fund. We raised our cash position to more than 50%. That's how we had the greatest performing gold fund of 66% on the year. But let me show you my gold stuff. I have a lot of stuff on gold here. January 30th, writing gold and silver calls. We sold calls using the high strike price. We made a quick, easy 4% for institutional clients if they followed us. They didn't have to sell the exact strike price we did, but it was clear that the market's not going to make a new high. So we sold the calls at that strike. What were we looking at? Let me show you what we were looking at. Number one, people think that gold is some sort of a magic instrument that's going to trade up along with the CPI. Okay, it trades up along with CPI, but often the price of gold exceeds the CPI to such an extent that you get a major bear market. Right here, in 1980, this is the red is the ratio of gold to the CPI, United States cumulative CPI. You see the spike here? Over the next 20 years, gold declined 86.27% relative to CPI. From 1980 to 2000, the CPI doubled, and gold was down nearly more than 50%. The relative loss in gold was 86.27% versus the CPI. So when everyone out, all the pundits are telling you buy gold because if the inflation goes up, gold goes up, it's just not true if gold anticipated the inflation. In this case, gold got so ahead of inflation, as inflation continued, gold went down relative to inflation. Same thing is happening now. This is only through December 31st, not through January. Gold relative to the CPI is way higher than it's ever been in history. Now, say the CPI is fudged, okay. But we all know with 100 ounces of gold, you can buy more now than you were able to buy 5 years ago. I mean, you can buy a yacht, you can buy whatever. I mean, which you couldn't do 5 years ago with gold. Gold has way exceeded the CPI. Now, I did studies, I managed the largest gold fund. I have this out of memory, but I did studies of the Weimar Republic in Germany, when you had the so-called hyperinflation, and they say gold was the best asset to own. Yes, gold was the best asset to own because stocks on an inflation-adjusted basis lost 95%, and gold on an inflation-adjusted basis gained 10%. Okay? If you take out the billions of percent of inflation in Weimar, if you held gold, not only did you not lose money, you made 10% over that 3-year period.
But it's not a trillion% if after you adjust for inflation.
Right. You didn't make hundreds of percent. So when people are saying gold is up 175% because of inflation, it makes no sense. Gold, even in the worst hyperinflation, did not outperform. And secondly, there was one correction during that. This is people don't realize it. There's one correction in gold during that hyperinflation period when gold corrected nearly 50%, while inflation was while you saw the hyperinflation. So gold, listen, I look at gold as a commodity, but it's a stable commodity. It's a commodity that doesn't deteriorate, so it's a very good hedge against inflation over the long term. But it depends when you bought it. If you bought it right here when it's low relative inflation, you're doing fine. But if you bought it now, if you bought it right here, up here, when it's at an all-time high relative to cumulative CPI, you got to be crazy to think you're going to outperform inflation. Look at gold relative to oil. Gold is at its highest price relative to oil. Now, oil is a commodity and gold is a commodity. Oil is mined and gold is mined. Now, oil has a benefit over gold. The benefit is all oil that has been mined, that has been drilled over the history, has disappeared. It's been consumed. Now, 1 ounce of gold that has been mined in the last 5,000 years it has been consumed. It's all above ground. So the supply of gold actually increases to a far greater extent than the supply of most other commodities. So gold actually has something negative relative to oil. Now you look historically, gold had a trading range relative to oil. All of a sudden, this spike wasn't because gold did well. This spike because crude oil traded below zero, if you remember, during the COVID crisis. Yeah. But this spike is because gold way outperformed oil. Why? They're both commodities. They both should hedge against inflation, and they both move up with inflation. This was telling you that gold was very, very strange, and you can't even compare it to this. This took place because oil collapsed. Let's look at gold relative to, look at volume. You had record volume in gold futures. You had record volumes in ETFs. You had record volume in spot gold. So record
volumes, Milton, but I don't believe records in
open interest. No,
yes, open interest or assets under management in the ETF. So maybe in Asia they were going crazy by buying tons of precious metals, but I don't think the retail speculation or Western, American speculation in gold rivaled that of 15 years ago.
That's true, but I'm lucky that over the years I've never built models using open interest. I only built models using volume. So volume may be the most important factor.
Fair enough.
I'll agree with you 100%. But right now the volume. So this is the reason to believe that this is heading towards the top. Okay, this is my chart on gold and volume. Let's look at this. This is gold relative to soybeans. Now, soybeans is a commodity. Like you buy soybean products in the supermarkets. Many things are made of soybeans, and it moves up with inflation. All of a sudden, gold relative to soybeans. Why? For this period of 20 years, gold and soybeans were oscillating. Right? You had inflation then. Gold didn't take off. If gold takes off, soybeans should also take off. Why should gold in Weimar, Germany? The price of gold went up, so did the price of soybeans go up. Mm-hmm. So let's face it. I mean, you could use soybeans as a hedge. You can't buy a warehouse of soybeans. But the point I'm making is that gold has outperformed commodities. It's outperforming CPI. It actually makes no sense to think. Look at gold relative to the typical home in America. CPI relative to the existing NAR medium sales price existing homes. It was way higher here in 1980, I admit, but now it's the second highest in history. No reason to think gold is going to really take off from here. It already took off. And the most important chart is this one. This is gold. This is a proprietary chart, which had created not gold in dollars, but gold in GDP weighted in all major currencies of the world. It's in Australian currency, US, Canada, Great Britain, Euro, Japan, Switzerland, China, Russia, India, Brazil, which are the BRICS. Gold relative to all currencies has surged. Now, you take a little bit, I used to work with at Oppenheimer. You had a guy named, I think his name was Jack Levy, who ran the company. He's a brilliant analyst. And he says what he does, he takes his grandson, Johnny, and he shows him a chart. Okay, and he says, Johnny, do you think this is going up or this is going down? And he says it's going up, it's bullish, going down, it's bearish. I say, tell someone who's a little more intelligent than Johnny, does this look like we're at the beginning of a move or look like we're at the end of a move? Just a little bit, look at charts. In other words, does this look like the beginning of a move? More likely the end of a move. Look at this big move. This looks like it's a trading range, but this could be the beginning of a move or breakout. This could be a breakout, but does this look like the beginning of a move? Of course not.
Well, Milton, I've got to ask you, don't you have bull markets in precious metals that last a very long time? 1971 to 1980, and then 2000 to 2012.
Let me tell you, listen to this. From 2000 to 2012, gold relative to CPI declined 85%. Gold itself declined more than 50%. So it came off 50% decline, right? So you had a bull market. Listen, this is gold. This is spot gold. It was fixed, so the price is false till 1970. Got it? So the first rally was just catching up for the fact that the price of gold was falsified. It was fixed by the government. It was $35 an ounce, regardless of what its true worth was. So the first rally was really a just catch up. The next rally was a speculative rally. It peaked. It peaked for 20 years. This rally, I mean, I say this gold rally we had started in 2000. It's 25 years old.
Yep.
You had a hiccup over here, pullback, but in reality, if you start in 2000 to now, you way outperformed his gold relative to CPI in 2000.
Do you think we have a multi-decade bear market in gold, Milton?
I think it's likely. I think it's likely that relative inflation will have a multi-year bear market in gold. I think I wrote it up to my clients. The likelihood is you'll see a multi-decade, let's just say a 1 decade bear market in gold is enough to say, but I think it could be multi-decade because gold is at the greatest extreme that it's ever been relative to commodities, and gold is just a commodity. And there's no reason to believe that gold will make you real money relative to commodities, relative to inflation. Listen, if gold does well over the long term, let's put it this way: if in the year 0 AD you had an ounce of gold and it was worth say $10 an ounce at the time, okay, and it gained 5% per annum until today, it'd be worth more than the money supply of every country in the world.
Yeah.
Gold doesn't compound.
Yeah.
Gold holds value, and for some reason, I don't know why, people have been taught and people are convinced that gold compounds and makes money. Gold is not an asset that makes money, as Warren Buffett used to say. You buy a stock like Apple. Apple generates little babies. It's called earnings.
Yep.
You buy Apple, and it gains in value because of the little babies that it produces.
And the babies have babies, and they buy back the shares, the capital expenditure, the dividend, you buy back more stock. Yeah, gold. And also, Milton, I will say, I try to be neither a gold bug or an anti-gold bug. But when people say, well, gold from 1971 did this, they're starting from a point where it was just going to explode because it had been artificially depressed from the gold standard. So,
that's my
and also I say, from 1981 to 2000, there was a 19-year bear market in gold. So no one is guaranteed to make money in precious metals, even on a 20-year time horizon.
I'm trying to, even when the Weimar Republic had this boom in gold, if you think about it, it's only because of the debasement of the currency. The United States did not have a boom in gold during that period. You understand? So it's really, gold doesn't really make you money over the long term. Now it's going to make you money sometimes.
Although, Milton, I will say, and you're showing this chart of gold priced in a basket of global currencies. Almost every currency, maybe other than the Swiss franc, has been weakening against the dollar. So in many countries, the precious bull market in gold and silver is even more extreme. So like in India, like the price of gold priced in Indian rupees has just been on a 50-year bull market that has never ended. So, I mean, I think a lot of people around the world are very bullish on gold. Milton.
Again, but the bullshit is because ultimately it retains its value. Ultimately, but if you buy it at the right time, I mean, I remember it's way before you were born, but in 1979, at the peak in silver, there was an investor that I knew that had really his fortune was all in silver.
And 1 year before the high in silver,
And then he saw silver was peaking, going to $40-$50, and somebody, you gotta sell. He said, I would sell, but where would I put my money? You understand? He was so convinced that you can't have money in paper assets. He said, I would sell, but where would I put my money? You understand?
Versus the S&P was at like 10 times earnings, and the treasuries were yielding 12%. So, Milton, you're looking at long-term charts in gold, and you're basically saying it's overvalued, even though I know you're not a valuation guy. In terms of the more short-term technicals in gold,
short-term, it had classic signs of a climax top. Let's face it, you had the accelerating gains. You had gaps in the, I don't know if you have the chart. You had gaps in the GLD and SLV. You had gaps to the upside. I don't use moving averages, but its ratio to its 200-day moving average was also at an extreme, the kind of extreme you see in speculative stocks at peaks. In these meme stocks, same kind of extreme, and that's signs of a top and signs of a bottom. And the fact that I was embarrassed to tell my clients to get out of gold because some of the titans of Wall Street were long gold at the top, between me and you. Okay.
Well, they probably made a lot of money. Let's be real.
Maybe right. That's true. They got in at the right time. I don't want to say, but one of my a former client of mine, who for whatever reason not a client anymore, I don't get into it. A good reason, not a bad reason. Got into the gold market way early. He's more than 50% in gold throughout this bull market, so he can handle this 12% pullback. Believe me. But I'm talking about the public. It was very difficult on the public. Very difficult.
Definitely.
So I did in gold, but to be honest with you, I wrote gold calls right here. I wrote gold calls the day of the top. The top was the previous day, the 29th.
Yeah.
And I said, we're not going to get back to the high. So I wrote very short-term gold calls to a total of 4%. So make it 4% in a month. So listen, for all I know, I'm going to be cursed and gold be up $500 tomorrow. But we sold. I think the average cost is $6 and $4. And then now, yesterday they're trading in pennies, 30 cents, 25 cents.
I would be shocked if those calls don't expire worthless. So what motivated you to short gold the day
It did?
after. And also, Milton, could you tell us when you wrote that shorting gold and silver, was it how much into the crash was it? Was it right
It
at
was
the top?
9:15. It was 9:15 in the morning. We said invest at. We gave an exact time to invest. Yeah, let me show. I said 9:45. We used the mean between the bid and ask at 9:45. We weren't going to scale it because we knew this. We just pick the price, time, and that's the price we use. But what I'm showing you here is this is the peak on gold on the 28th. Did I tell you about the silver refiners? Did little fundamental work. Silver refiners are so overwhelmed with incoming inventory, they have stopped accepting additional scrap metal. This suggests that at a fundamental level, current prices are pulling significant new supply into the market. At the 2011 silver peak, when I worked for a hedge fund, refiners were running 3 8-hour shifts a day and still did not need to turn suppliers away, whereas today, conditions imply an even greater supply response to these price levels. In other words, I was pointing out that the high price of silver today, on a real basis, is greater than the high price in 2011 because the refiners are turning away supply, which means to say there's such an overwhelming amount of supply. Yep. Overnight, this is on January 29th, we saw the market rally this amount, and we wanted to get this high. So we suggested shorting beginning about 11 o'clock in the day and shorting down.
So you shorted that gold at about 5,400. Incredible move. Incredible move.
Yeah, but okay, you got it. I wasn't. Anyway, that's the story. So Bitcoin.
Wait, Milton, I'm sorry, but in terms of technical analysis, you said gold relative to its history, relative to CPI, is overvalued.
And technically, it had all the signs of a climax
of high volume, but was that it?
Climax peak. You had gaps into the high. You had record volume into the high. You had people. You had the record volume in the most retail-oriented types of investments. The ETFs, the gold bullion dealers who sell to the public. You had record volume on the retail side buying, and the natural sellers, people who already own gold or own gold scrap or own silver scrap, were sellers. It was drawing supply. So on a technical basis, it was a peak. On a fundamental basis, it was a peak. The parabolic rise with with exponential greater increases on gaps. That's all you need to see. You can just look at stocks that have peaked historically. Stocks that have peaked on parabolic rises show exactly the same idea. Gold was just a very high cap stock that was peaking.
And are you still bearish on gold and silver? What do you think? What do you see right now?
I'm bearish in gold and silver. Yes, I think gold and silver will have a long-term decline. Although you're listening, markets can surprise you. If it surprises us, we won't be surprised because we'll see it in the data. I don't think it'll make no highs. People who follow other techniques say that we've seen pullbacks before to this extent that are followed by new highs. I mean, you've seen it in Bitcoin in the past. Gold is a far deeper market, and it's highly unlikely after this type of a decline, if this type of a panic buying, that you'll see new highs. Highly unlikely. I tell you, if you do see new highs, there's only one. Oh, you're reminding me of my research. There's only one time in history when gold made a rounding top. Commodities in general make spike tops. Gold always makes a spike top, as does silver. The only time it's made a rounding top, which means it made a high and then tested the high at a slightly higher level, was in 2011. I think its final high was September, and it made its first high in July. And the September high was slightly above the high in July. So that's called more of a rounding top. But generally, the type of top we saw in gold is the type of top you see in commodities, and particularly you see this type in gold.
And Milton, so, I'm sorry, I've been a giant nerd on silver, so I got to ask you a few questions. So you've been experienced in the precious metals markets for before I was born. So silver, copper is almost all used for industry, for almost everything, wiring, used in vehicles, etc. Gold is mostly used almost all as a precious metal to store it in a vault or as jewelry. Obviously, gold has some industrial uses. Silver is interesting because a lot of people have silver bars. It's for saving. It has a monetary thing. In history, it was used as monetary. It's in the Bible. But then there was a very vicious a demonetization of silver, of governments and central banks selling silver. Yeah. So basically, silver is not money anymore. Mm-hmm. But some people do see it as a precious metal, and it rallies alongside gold often and sells off alongside gold, just with more volatility, higher beta. Mm-hmm. But then silver is a giant industrial metal that historically was used for photography in the 60s and 70s. It was used a lot for electronics. And in particular, more recently, it's been used a lot for solar panels, which is, the technology of the future, let's be honest. Yeah. And there's a record shortage of silver for the past 5 years. and basically above ground stockpiles have had to be depleted in order to meet this shortage. And Milton, and I'm just setting the stage. Obviously, I know you know this,
Yeah.
but the bull market of silver from 2000 to 2012 or 2000, around there. For the first half of it, it had a physical deficit, like there was a shortage of silver.
Yeah.
But
Yeah.
for the second half, and Warren, once there stopped being a shortage, by the way, Warren Buffett sold. He made money in silver, but he sold once the fundamentals told him to sell. But from like
Mhm.
2006 to 2011, there was a surplus of silver, so it was just an incredibly speculative asset, and everyone was just getting long silver. Let's go
Mhm.
long silver. So to me, Milton, I have been long silver in various ways from like precious metal royalty companies
Yeah.
and stuff.
Yeah.
But to me, there seems like an obvious deficit. But should I respect the technicals, and should I accept that silver is going to be in a bear market, even though I'm looking at and I'm seeing a shortage?
There's a lot of silver. It's always been mined for millennium, just like gold has been mined. Now, of course, not all silver remains above ground like all gold remains above ground, but a lot of silver remains above ground in various ways. Silverware, for example, and where I see it, people are nitpicking by saying there's a shortage of supply. The way I see it is, in speaking to refiners, there's a record supply. So I don't necessarily believe the fundamentals. I do know that back in 1980, when silver was peaking, you had the same kind of stories. There's a shortage. Well, mainly it was due to photography, they claimed,
Yeah.
but there's not enough gold. So I've heard these stories before. I'd rather stick with the technicals. And the technicals are telling you that we saw an important peak at the end of January, early February. Whether or not we make a higher peak in the near future is anyone's guess, but I don't think we'll make it very, very soon. I don't think it's just a little hiccup in which we go much higher.
And
But
that work about the smelting, about how all the silver smelters are not accepting silver. Is
yeah,
that in the news? You're reading reports, or you're on the ground analysis? Where is you getting that?
we got it from two places. Okay, I sold my personal gold stockpile on Thursday, the day of the peak. Okay, so a friend of mine is the largest smelter in New York. I don't want to mention his name, but he's a legend in the business. Okay, so a lot of my information that comes from him, and a lot of information comes from just reading.
Yep.
And I just know that this is not a question. You talk to any smelter. Back in 2011, I was working for a hedge fund that had actually the largest position of gold and silver of any hedge fund in the world. They were second to Sprott's Gold Fund.
Yep.
And I did a lot of research, and I remember speaking to refiners in Texas, telling me, "Oh, we're running 24 hours a day, 3-hour shifts, and this rally in silver will never end because there's a shortage." And I said to myself, if they're running 3-hour shifts, there's some supply coming. There's definitely no shortage. And it's just the opposite. People look at it. It depends how you look at things. Most people are saying, "Wow, the smelters can't smelt it. That must be a shortage because they're not able to come up with supply." But it's telling you there's an underlying supply looking to smelt. See it depends how you look at it. We
Yes.
shall see. So far, the market has spoken. The market so far told us it was a speculative fever into the peak, just like you've seen in stocks like Cisco. There are great companies, or even Amazon into the year 2000. And Amazon declined 19%. As great a company it is, so as great as gold and silver might be, you had a speculative move, and it had all signs of a top. And the decline was historic, and you're going to get bounces, but I think ultimately you should go down for a while. And I don't like to project. Things could change. If things change, we'll act upon it. Hopefully, we act upon the change. I don't want to get caught into any one position, but I think that was a very historic peak in gold, and it didn't surprise me. One of my clients, when I put that position out of selling, I put a negative piece out on gold before the peak, and they sent me all this kind of information. How gold and silver, the shortages, and all
The shortage, Milton. Don't you know about the shortage?
Monetary policy, and all this kind of stuff. Doesn't I stick with the market. You want to talk about Bitcoin?
Yeah, yes. Okay, so you're bear on gold, bear on silver as well in the near term. Thank you for saying that.
Yeah.
Tell us about Bitcoin, which it's selling off very viciously. It's a very tough time in Bitcoin right now.
Had a very big move, very big up move today, as you know, right?
After a huge down move, yes. So
Yes,
Milton, for our audience, Bitcoin peaked at over 120,000 in October of 2025 last year, and it's trading very, very poorly, and it was as low as 63 or 64,000 in early February, but today, February 6th, it's rallied back up to 70,000. Your thoughts?
Right. My thoughts. First of all, I don't like to talk about cycle dates because most people whether retail investors or institutional investors, are not familiar with cycle dates. The great investors, I can't mention names, but the world's top investors, not a Warren Buffett or total fundamentalist, but the names that people know about, many of them are my clients, are very familiar with esoteric cyclic work. In other words, you're not talking about seasonality, and we're not talking about early which months are strong, which months are weak. We're talking about other cycles, natural cycles. Anyway, I don't know if you're familiar with the great analyst Paul McRae Montgomery. He was an analyst for about 40 years on Wall Street roughly till about maybe 2000, 2010 or so. And he did a lot of cycle work, and he was my mentor in a sense when it came to cycles. So we have his cycle work going up to the year 2100, and he had October 6th as a cycle date. He also had February 3rd as a cycle date. Okay, so Bitcoin now.
You said 2100. You mean 2100 in 80 years?
Yeah. Cycles. Okay. So listen. So the way cycles work is people confuse when they talk about cycles. They think every cycle is going to affect every market. It's not true. A cycle will affect the market if the market is prone for a turn. Cycle dates predict turning points. They don't predict accelerations or decelerations. They predict turning points in the market. And cycles work along with, let's say, human psychology or human emotion or with sentiment. If you have a market that's been peaking with a lot of sentiment, or your market's been declining, a lot of negative sentiment, with a lot of headline news about it, and it occurs in a cycle date, you have a greater than random probability that the market is going to peak, okay, or going to the bottom. Bitcoin and gold are the two assets that work best in cycle dates. Gold, because all gold that has ever been mined in the world is above ground, and the supply increases every year, so it's different than all other commodities, and basically moves on sentiment. It doesn't move on supply and demand fundamentals, because the supply is there for millennia, and the demand just changes based on sentiment. So cycle affect gold very, 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 very well, and so does cycle affect Bitcoin, because there's no value to Bitcoin at all. I'm going to get to that in a moment. I'm going to share with you and your readers, your viewers, things that they've never heard about Bitcoin, which is you probably seen it on one of the next few pages. But in any event, Bitcoin did peak on a cycle date October 6th, and it made a crash low into February 3rd cycle date. So we thought that might be a final low. I told the clients it might be a final low. However, I said, if that is a final low, basically it's testing the low we saw in April of 2024. See this April 2024, and this is February 3rd. So my view, when a market tests the low, sometimes it's the decline stops right before the low. It doesn't quite hit the low, or sometimes it declines up to 3.75% below the prior low. So I said, if the 71,651.33 level holds past today's close, I would recommend Bitcoin bulls to increase exposure using the area of the low as a stop. In other words, I told my clients, I'm not a bull on Bitcoin, okay? I think Bitcoin, you'll see in a minute what I think about Bitcoin, but I don't recommend people go long Bitcoin because it makes no sense to me. But I have clients who are big in Bitcoin. I told them you should consider buying around here, but only if this low holds, because then it'll be considered a test of this low.
And it didn't hold.
It didn't hold. So that's the next page. The low failed. This is the low. The test would have been 71,000 and changed. It got to 61,000. So the low failed. And I told my clients, if you're considering buying Bitcoin, don't buy it, because the low failed and anything can happen. Now, of course, maybe you have a panic low and it's going to turn up. We'll see that later on. Now, what exactly is Bitcoin? I've read a lot about Bitcoin. Of course, I never could get my mind around it. I still don't get my mind around it. I finally found out, there's a number of books written about it, but I see the intellect, the academics also understand Bitcoin. And this is it. The origin of Bitcoin is the RAI stone on Yap Island. Are you familiar with this?
From you, yeah.
Okay. These massive circular discs made of limestone have been used as a form of money on Yap Island for centuries. This is in the books about Bitcoin, I promise you. I've read a number of books about Bitcoin, and they all come up with Yap Island as a justification for why Bitcoin is money. And the story is nothing short of fascinating. From their origins as a currency used for trade and social status to enduring significance in Yapese culture, the raised stones have truly shaped society. Okay, let's continue. Researchers from the University of Oregon, specifically Mr. Fitzpatrick, I hope you're listening to this, so Mr. McKeon, anthropologist Scott Fitzpatrick, and finance professor Stephen McKean are key figures who have compared Bitcoin to the ancient RAI stone of Yap. In their paper, Banking on Stone Money, Ancient Antecedents to Bitcoin, published in the Journal of Economic Anthropology, they argue that Bitcoin is similar to these stones because, Both are highly valued, rarely moved. Like Bitcoin's ledger, ownership of heavy RA stones was transferred through public verbal agreements rather than physical movement. A form of distributed ledger. Anyway, the point is there were these big stones that was difficult to move, and people would buy and sell things and use a stone as to remind themselves of the transactions. And there were thousands of transactions based on one stone. And this little island of Yap, people remembered exactly which stone represented which transaction. So instead of having money, they just go to this stone and remind themselves that Mr. Yap A sold his daughter to Mr. Yap B in marriage, or Mr. Yap A sold his boat to Mr. Yap C, and they look at the stone and they remind themselves and have a record of what transactions took place. This is the closest and the most logical explanation I've ever seen of Bitcoin. Because other than that, Bitcoin makes absolutely no sense. There's no other currency in the world that's compared to Bitcoin. Gold has intrinsic value. Gold is used as jewelry. Gold is beautiful. People give gold to their girlfriends. People give gold to their wives. People give gold, transfer gold to the next generation because of the value, because of the beauty. Gold has been used for years as money. So too silver. So too bicycles. There were times when bicycles were used as money during wars. My mother told me candles were used as money during World War II. But all these things have intrinsic value. There's something you can do with it.
In prison, cigarettes are used as currency.
Cigarettes use as currencies, right? Yeah, exactly. The bicycles, I was told this by what's the Treasury Secretary's name?
Scott Bessent.
Scott Bessent told me about bicycles when I used to work with him at Druckenmill. He said, yeah, he remembers when bicycles used as currency in his readings. I mean, he's an expert on all these things. I mean, he's a monetarist, far greater than anyone we know. But let's continue. So the Yap stones were different. Yap stones wasn't money. It was just a way of recording transactions. And it was a small little town, a small little island where you look at it and you remind yourself of the transaction. It was nothing to do with money. Bitcoin has no intrinsic value at all. You can't say it's cheap when it's at $60,000. You can't say it's cheap when it's at $10,000. You can't say it's expensive when it's at $10 million because there's no way of measuring its value.
There is no way of measuring its value on the way up. There's nothing in terms of overvaluation to prevent it from going up way more than you imagine. And on the downside, there's no valuation.
Exactly. There's no value. There's no reason money. It's a fallacy. Nakashomi, whatever his name is, who made up Bitcoin, he didn't understand what money is. Money isn't something simply because you have to pay. It costs money to mine it. Because I gave the example before Bitcoin even existed, when I ran a gold fund in 1980, before gold, people said gold is valuable because it's rare. It's valuable because it's expensive to mine it. I said, well, what if you took a 1,000 used paper cups and buried it underground and protected it with nuclear arms, and it'll be very expensive to mine it? Would that give it any value?
But there are other paper cups that you could easily make.
No, they're not. The paper cups that are underground.
Yeah, but
I'll mark each paper cup with a way that no one knows. You can't duplicate it. You can't counterfeit it. Would anyone in the right mind think that's money?
No. Okay, but Milton, okay,
intrinsically money. Gold isn't money because people think it's money. Gold is only money because it is money. Now, the dollar isn't money. So Milton Friedman says the dollar is a fiction, but Milton Friedman is a fiction. The reason the dollar is money is because it's backed by guns. It's backed by prison cells. If the government wants you to pay taxes in dollars and you don't pay it, you go to jail. So it's not money because it's intrinsically money. It's money because it's backed by the forces of the U.S. government. So too other money. Now, money is not backed by forces of the government. Hyperinflates, it disappears. So the point being is that Bitcoin is a fallacy. Bitcoin is false. There's no sense to Bitcoin. And it simply trades as a speculative, I don't call it asset, as a speculative item that absolutely makes no sense. When people say Bitcoin is cheap because it's $60,000, cheap relative to what? Bitcoin is expensive at $10 million. Relative, I'll tell you relative, if somebody would take his $60,000 and instead of buying a Bitcoin, he'd buy a Tesla, at least that's something he could drive.
Yeah, Milton, I'll tell you what, when people say Bitcoin's cheap, I'll tell you what they mean. Milton, over the past year, gold has doubled, silver has tripled, and the S&P is up 40%. And in the meantime, Bitcoin is down. So therefore, Bitcoin must be cheap. That's what they mean.
Okay. Well, it depends. Again, when's your starting point? A relative of mine who's a genius when it comes to computers and stuff, he bought Bitcoin at 4 cents.
That's pretty good.
He sold it at 8 cents, and he redid his bathroom. Okay.
Mm-hmm.
So in other words, guess what? He didn't make a mistake. It was worthless at 4 cents and it was worthless at 8 cents. It was just a good trade. If you buy Bitcoin, you sell at a profit, it's a good trade. If you're like Michael Saylor, you buy Bitcoin at $76,000 and now it's at 60,000. So far, it's a poor trade. If it goes up, it's a good trade, not because it made any sense, because there are other people who are willing to pay more for the value of Bitcoin
Absolutely.
than you were able to pay for the value of Bitcoin. And here I challenge the bears, I challenge the bulls, and I challenge anyone out there to explain to me the value of Bitcoin other than the fact that it's something to do with these RAI stones.
I got you, Mill. I got you. I got the Bitcoin bulls. I'll do them a solid on their behalf, which is Milton. I told you I was into the mineral royalty business and looking at those businesses. So I said, what are the mines that last the longest? So silver mines only last 8 years. Gold mines only last 15 years on average. Copper mines could last a lot longer. Interestingly, rare earth mines actually last like 50 or 100 years. Potash mine lasts maybe 100 years. Limestone mines is one of the most common materials in the world. There are limestone mines that last hundreds of years, 500 years, and maybe my Gemini, Google Gemini large language model is just making this up for me. I don't know, but he told me that there are some mines from the Roman Empire that are still mining limestone. So you said that these things are made out of limestone. It's one of the most common things in the world. Bitcoin is very scarce, artificially scarce, but it's scarce. And therefore people say it must have value. So that is a difference between those limestone stones and Bitcoin.
Yeah, but the limestones were scarce because they had to have a hole in it, you see? They had to have a hole in it. And it was scarce because they had imported from another island. The limestone stones couldn't be mined in this island. It was a very small world in those days. And but I'm saying the main value was because the people around knew exactly who the other side of the transaction was. Unlike Bitcoin, where you don't know who the other side of the transaction is. It's a different concept. But guess what? Limestone is, you're saying limestone has nothing to do with Bitcoin. Or you're going, so right now.
Yeah, I'm going against you. Yeah.
No, I'm not saying Bitcoin. I'm against the using limestone as Bitcoin. I'm saying when you study the research, the best they can come up with is the REI stones in Yap Island. Rarity is nothing. Listen, I have a sock. I have a sock with a hole in it right now on my face, right? It's very rare, but it's valueless. There's only one in the world. What would give it value? And you can't duplicate it. You see what I'm saying? It makes no sense. There's no logical thing to say that if something's scarce and it costs money to mine it, if someone lives in Los Angeles, he has to fly to Florida to get my stock. Does that give it any value? Absolutely not. It's a fallacy. The whole thing's a fallacy. So as you said, if it goes to zero, it goes to $10 a Bitcoin, that's its value because that's what people pay for it.
Right.
If it goes to 10 million, that's its value because that's what people pay for it. But everything else in the world has a value except for the dollar. But the dollar's value is what the government places on it through their guns and through their army and through their police force.
Milton, you're making fundamental arguments, and the fact that Bitcoin doesn't have a fundamental argument, basically. I understand your argument, but when you look at the technicals, what do you see? Because that really is kind of all Bitcoin has. Is
there's no technicals. There's no advanced decline line. There's no natural end user. There's no.
It's the same as gold.
It's one thing. It's not like gold where it has some industrial uses. There's nothing to measure it either fundamentally or technically. I mean,
but Milton, it's got a chart. It's got a chart.
Yeah. You look at volume. You look at moving averages. But what I look for in stocks technically is far more robust. When anyone can look at, and even want to look at it in gold, it's far greater because at least gold has some uses and some supply demand factors other than the fact that it's scarce. There's above anyway. Yes. Okay, you'll be a believer in Bitcoin. And listen, everyone's been right in the sense that Bitcoin went up in value, it went up in price. But as Benjamin Graham said, listen, I don't believe much in what Benjamin Graham says either about value investing. But Benjamin Graham missed every bull market he was alive for because nothing was cheap enough for him between me and you. And even Warren Buffett would have missed many bull markets had it not been for Munger, who told him to buy good companies, don't just buy cheap companies. And Buffett, we don't know how bad it's going to be, but he says a $300 billion war chest just waiting for stocks to get cheap. Ultimately, it may turn out great. We don't know, but we certainly missed some upside due to that, which the hedge fund people that I deal with don't miss the upside because stocks aren't cheap. They don't care whether the stocks are cheap or not. They care about other things. But what I was trying to get to about Bitcoin is that I don't see any case that can be made in history for Bitcoin. And people were stretching to compare to the REI stones. And as I say over here, we disagree. REO is a far better form of money than Bitcoin. I don't see anything about Bitcoin that gives it a monetary value. And but people, the reason stocks go up in value isn't because people are buying it. As I say, Apple has little baby apples, and Nvidia has little baby Nvidias, right? And Walmart has little baby Walmarts, but Bitcoin has no little baby Bitcoins. So how are you going to measure it? And it has no uses. How are you going to measure it? I mean, you can argue from here to tomorrow. It's my view, and people say I'm wrong. So why say Benjamin Graham? Because Benjamin Graham, in his book, Security Analysis, he says people think a successful investment is one that went up in price, and they think an unsuccessful speculation is an asset that went down in price. That's not the case. That's the other criteria that measures whether something is an investment or something is a speculation.
Stocks and bonds have fundamentals.
Bitcoin is not an investment. And all these little widows and orphans, the people putting Bitcoin, and all these institutions that are allocating 5% to Bitcoin absolutely makes no sense other than the fact that they saw it going up in value. But no one can sit in front of me and give me a logical reason for Bitcoin to be a valuable asset. No one, not you, you're not the only one. I hadn't, at least maybe I'm stubborn, but I just don't see it.
Yeah, but you're talking fundamentals. So technically, you don't have any analysis of Bitcoin other than the line.
Technically, it has no value. Technical analysis just interprets value, but it doesn't give you value. Bitcoin, gold has value, but Bitcoin has no value. The fact that it has a price doesn't mean it has a value.
Let's move on. Let's return to where we started, which is the stock market. You had some overwhelming buy signals in April of 2025. You had one more buy signal in the summer you didn't really believe in. You got a sell signal that made you anxious, go short on your model portfolio on December 11th or early December. And then you saw another signal that you didn't like, a sell signal in January. What's your positioning now? And Milton, I might say, based on how you started and saying, oh, I still want another 5%, 6% more in the S&P based off the huge starting gun, bomb that was August. Sorry, that was April. Based on that, I'm familiar with just how short your model assets portfolio is. Like, why are you?
I'm not hiding it. I'm long about 5% Argentina. We got into it at the lows. We also had a classic bottom in Argentina. If you're interested, you'll see.
Right, Milton, but your short positions in other assets are 20 times larger.
I'm 110% short various. I'm short the mid caps. I'm short Russell. I'm short the Qs, and I'm short the SPYs.
That's all. And semiconductors, right?
Yeah, and we just went short semiconductors the day after their top. Exactly. Yep. Yes.
So why is your positioning so bearish if you only have a few sell signals? Or what am I missing?
I told you, I'm short because my VXN sell signal back in December 11th has not had the market follow through. All follow through so far have been signs of speculative tops. You had the island top of the Russell. You had the fact that the Russell is moving up without the S&P 500. You had the maximum gain since December 11th was 1.12% in the S&P. You had the fact that the Nasdaq wasn't able to make a high above its December 29th high. You have a lot of factors telling you the market's topping. That's why I'm short. Why I'm 100% short? Because I don't go in increments. If I'm short, I'll be short. If I'm wrong, I'll get out. I told you this morning I consider covering my shorts. That's why I wrote the report. I wrote based on the various indicators we saw. There are sometimes in the past we generated the exact bottom, especially after a sharp spike decline. However, it never took place with a decline of only 2% or 3% of the S&P. But maybe tomorrow, Monday, I'll change my mind if I see follow through it, or maybe my indicators will come up with even more buy signals than the one I saw at yesterday's close. We're flexible. But actually, this morning when I wrote my report, initially I titled the report "Covering Shorts." That's the initial one. And then I ended it saying we're not ready to cover our shorts. In other words, as I wrote the report and went through the data, I see reasons to cover the shorts, but not enough to cover my shorts. But this is not a long-term call. I said I could see a depression. You never know what's gonna get through to a bear market until it takes place. When people predict a crash ahead, very rarely do they know why it's going to crash. If they're correct, most often they're not correct. Even when you live through a bear market, you generally don't know what's causing the bear market until the bear market takes place, or even a bull market. You don't really know what's going to what turns bullish. The market anticipates it, and you don't really know what's going to cause it. But no, we're short, and we may be long on Monday. But the point I want to really make is that for the real people out, the millions of people out there who have IRAs and 401k plans, and they want to invest for the long term, they want to save. Forget about all this stuff. This doesn't help anybody. It just drives you crazy. Bull market, bear market, AD lines, seasonality, broadening, or Russell 2000 moving, which is a bullish sign. just know the SPI, if we remain a capitalist country, which we hope we do, I mean, there's been many times in the past where it looked like socialism will take over, like during the Great Depression. If we remain a capitalist country over the long term, the S&P 500 should gain in price in real terms. And if you're in for the bulk of bull markets and you're in treasury bills during the bulk of bear markets, you'll do very well. And until I'm not a young man, until last September, I didn't really complete models that allow me in confidence to say, be in the S&P 500 for the bulk of the time. Hold on. Be long during bull markets. Don't worry about all these pundits who are telling you there's a crash ahead, a recession ahead, a correction ahead. Wait for the correction to start. Wait for the correction to be down 8% based on the model. And then when you're out, get into T-bills. You can sleep when you're in T-bills. T-bills are not the best investment, but they're certainly the safest investment. And then when the time comes to buy the market, you don't have to guess. Because our models, I say, in April 4th, April 9th, we showed 57 signals. From the month of April itself, I think we have a total of 88 signals published. We have many signals that are unpublished. I mean, published meaning it through my computers. So markets give you rare signals at turning points. We believe we'll be able to pinpoint them in the stock market, and we believe as long as you can get into the market early in the bull market, as long as you can get out early in the bear market, you'll do very, very well. And that's what our models are showing. And our clients get a newsletter twice a month telling them what they're up to. Very little data, not the kind of data we've been talking about here. They just get what the latest signal was. Occasionally we'll give a historical signal, what signal in 1974, or what signal in 1990, what signal in the year 2000. We may show historical signals that went into the model. But remember, the model is only built on one signal, the first signal of the series. Mm-hmm. I do not disclose to the retail clients the thousands of models we have. That goes for the institutional clients. It's a totally different ballgame. Plus, institutional clients, I recommended sectors, I recommended precious metals, I recommended long and short and leverage. And clients is simple. Either 100% in the stock market based on the capitalist system in the United States, or you're 100% in treasury bills because there's a correction or a bear market and you want to be out of it. Very, very simple.
Absolutely, Milton. Yes, generally you're right. I mean, American companies have a much higher profit margin, return on equity, and capitalism is generally good for stock markets. I mean, look at China. But I will say, Milton, in fundamentals, like there is a lot of counterpoints. Like in Brazil, when the left-wing guy was in charge in the very early 2000s, Brazilian stock market did really well because there was a bull market in emerging markets and oil. So there's always a counterexample. I want to ask you, Milton, about exactly what you showed. The individual name, your long-only position.
It's a long-only portfolio. This long-only portfolio is institutionals get every day a long-only portfolio. Our turnover average is 75% a year. We don't even have 100% turnover, okay? We try to own stocks for at least a year. We buy the stock strictly on technicals. However, I do try to make sure the companies don't have any balance sheet issues. I don't want to get into a bankruptcy. We fortunately had a great return. This started in 2016, January 1st. Our model,
that's good.
This is not total return. It's just price action up 542% versus 236. Since 1919, it's up 467% versus 174%. Since 2022, 151 versus 44. Since 2023, 191 versus 79. From last year to date, we're up 53 versus 17%. And this year we're up 7.56%. This is through February 4th versus the SP of 0.54%. Now, how do we do it? We don't do a lot of trading. And we do it based on technical analysis. Just to be honest, I learned a lot of what I know about technical analysis from William O'Neill's. People are very familiar with William O'Neill's work. But he would stress growth stocks, and we use his pattern analysis for cyclical stocks as well as for undervalued stocks or beaten down stocks. We try to get early in the turn. So to give you an example of what we own now, which is sort of the portfolio, this is the portfolio we own now. We own Argentina as an ETF. We have a 4.9. We're up 36% in Argentina. We have a number of foreign stocks, and the foreign stocks are showing greater potential technically than the U.S. stocks. We have Ator, which is a Chinese. Many people wouldn't have heard of this stock. It's a Chinese, I guess it's like TripAdvisor or Travelocity. I'm not sure exactly what they do fundamentally, but they're for people going on trips. Chinese people like to travel. This is their travel company. Alibaba, Berkshire. We have really, I think it's a great management. There's a technical reason I bought it, but really I bought it because I think it's sort of a cash asset. I'm still nervous about the market long term, and I'd rather have 4.6% in Berkshire because I think in a bear market it would hold up a little better. Constellation Energy we spoke about 2 years ago, if you remember. I said
incredible pick.
Remember that? I said I don't know why I own it, but the chart was great. Turns out it's an AI stock. We're up 94. We sold half the position already. The stock went over. We had an over 5% position, and we sold half of it. So,
and I see one of your biggest position is Seagate, which is data
Well,
storage.
so I'm going to show you some charts. We have Shinhan, Korean. Let me show you some purchases. So these are recent purchases. We own G Vernova. We bought in the last year. We bought it right here at this breakout.
And by the way, Milton, I know you don't focus on fundamentals, but in the fundamentals, GE was this business that had issues for so many years, but now they spun out this business and they basically have natural gas turbines, and there's a giant shortage of natural gas turbines.
I do look at earnings, but I look at earnings on a technical basis, not a fundamental basis. I don't really care what brought there. Anyway, we bought it back here where the arrow is. I just bought this recently. Shinhan Financial Group, which is a Korean stock. Look at the new high. This is today's chart. I made a new high today. Look at that one. You see? So this is doing very well for us. Again, it had a very low P of 9. It was actually a P of 7 when we bought it. And you have a stream of good earnings, but you had this kind of a big up move consolidation and breakout. I'm looking for stocks that are, American stocks didn't show these kind of chart patterns. KP, another Korean company we bought right here. It made a new high a few days ago. Now it's okay. And the last one is Seagate. My guy works with me, a very brilliant guy works with me. He's been in the business for quite a long time. He used to be a trader for himself, and now he works with me. And I bought Seagate. He was yelling, "Milton, don't buy Seagate! Don't buy Seagate!" He said, and he gave me all the fundamental reasons not to buy it. Well, the technical reasons that he believes not to buy it. Overpriced, everyone's looking at it, and so on and so forth. And you had this breakout on a gap, and I bought it right there. The earnings. I didn't really care. I saw there was strong earnings. I didn't care what my guy who works with me told me. And he thought he'd be right, but here it is. Just made a new high a few days ago. It's one of our best performing stocks. We own it for less than a year. Now, I know it's very vulnerable. It may come down, but we try to hold stocks for at least a year. We don't always do it. We try to. So this is the kind of things we do, and this only goes to institutions.
And what are your newest additions, Milton?
The last year or the latest one? The last one was Finia Auto Parts. It's up 17%. I just bought it not even 2 months ago. I don't want to bring up the full chart now. That's the new one. Finia. Korea Electric Power that showed you was pretty recent. Insight was pretty recent.
You got Google. You got Google. That's interesting.
Google's the old one. Old, probably 2 years already. Google. Generac was in the last year. It's not doing so well, down 3%. Let's see. Argentina was a purchase in the last year.
That's good. Hey Milton, I got something for you, which I know you like to prepare for stuff, but I figure I just wanted to throw a ticker at it.
Yeah.
Just software. There's technology, but there's hardware tech, and then there's software tech. Software tech had been performing so well for many decades now, but software is in a brutal bear market. That the fear being that AI is going to make these a lot of these software companies obsolete. The ticker, Milton, is IGV.
IGV. Let me take a quick look. Ooh. Let me bring it down here. This is IGV. I see nothing. I see no reason to buy the stock. I just say, wow. It made a rolling top here. I don't know the technicals yet, but
yeah.
IGV. Wow. I mean, listen. One thing you see, there is one positive in the stock. High volume occurs at turning points. Okay, high volume doesn't take place at the top here. High volume took place when it's down. I don't know, down to it must be down 50% or so. I don't know if it's high. So the fact that you see this high volume, that's a sign of a top. You look at stocks or indices at the bottom, you're going to see this kind of 5-day high volume, record volume. That's one of the things we saw back in April. We see it in many major lows. You see this high volume. That's the only thing I can see in this chart going for it. I don't see any testing of a low. You can argue the test of this low, but it's really too far back to be considered a test. And probably there have been fundamental shifts since then. A technician would call this level as a potential test. I probably wouldn't. When it comes to stocks, I like a 3-month range roughly for a test. I mean, wow. Do you expect me to like the stock? What was your opinion on the stock?
No. I wanted your commentary. I mean, I think a lot of these software companies have been perceived by the market historically to be high quality companies, high return on equity, high growing their revenues and earnings a lot.
But this is an ETF. This is an ETF. It's not an actual stock.
Yes. So
you look at Microsoft, which is one of the components.
Yep.
There's nothing beautiful about the stock. You have strong earnings and a weakening stock. Look at this double top right here. Look at these double reverse. It's amazing. A negative technical stock. There's no reason.
I got some of the worst tickers for you. Try Adobe or Salesforce CRM.
We owned Adobe. We got out of it pretty well. In fact, my guy I work with was pointing out, boy, I got out of PayPal and I got out of Adobe, in the last year or sometime, and I said, wow, you got out pretty well. So usually I get out of a stock because I find another stock to buy. And what I look is I
Yeah.
skim the tables for stocks that are showing me what I'm looking for. I couldn't find any today, for example. And then when I put a stock in, usually I take out another stock, for whatever reason. Adobe, wow. But Adobe, you took a look at a monthly chart. It was once a leader. Look at this, amazing leader. Yeah, Adobe learned how to rip people off. I used to buy Adobe. I paid $200 for the disc. I used it for 4 years. Then they started a subscription basis, which at first people thought was very negative. Subscription basis, yeah, stock decline.
Yep.
And now I'm paying them $250 a month for my subscription.
It's nuts. Yeah. Milton, try look at Service Now. Ticker is NOW now.
NOW, yeah, that was a big leader for a while, right? This is a long-term chart. Wow. And on a short-term basis, daily, it's a dog. Listen, you're seeing the increase in, this is one thing you see, increase in volume. But when you see stocks with strong earnings coming down, the market knows more than the earnings know. You understand?
Yep.
You want to see strong earnings at the market. This is amazing. I never own ServiceNow. I did own Adobe. I didn't own Microsoft. I did own PayPal, which is really a dog, they say, right? PayPal is down 90% of its high. This is PayPal. I own PayPal, but I got out well. I bought it
Me
well.
too, and I did not get out well. PayPal is tough for me.
PayPal, yeah, look at that stock, PayPal. I was one of the first analysts to recommend Tesla, and I really didn't trade it. When Tesla had its new issue, and it came out with a new issue, I said the pattern of Tesla's new issue reminds me, or is very similar to the pattern of Cisco when Cisco was new issue. But I didn't trade it well. I got out early in the move. But I was really one of the first technical analysts. I remember, I don't want to mention your name. I met with a analyst who was negative. He's a famous bear. He was negative on Tesla, and he said it's just an oil company and all the came. And I said, Tesla's selling cars without advertising. Not one app. This is when Tesla first started. They sell cars with no advertisements. I said, this tells you something about the underlying demand for electronic cars. That's all I needed to know. They were selling cars, volume was increasing, but they weren't even advertising. I mean, which car maker doesn't take ads in the Super Bowl, or whatever it is, just to get his name out there and to show how great the car is? Tesla didn't need that. So Tesla was a great long-term stock. It's way overvalued. I haven't bought it. I never owned it in a long portfolio. I don't see any reason to own it now. You see, you saw a breakout of a consolidation, but you saw it with weak earnings, and the stock wasn't cheap by any. So I wouldn't buy this kind of a breakout. So I don't like. There's nothing about the chart of Tesla telling me to buy it. Again, like Bitcoin, you want to own it because it's gone up, but that's not a reason to own a stock. You want to own it because it's gone up with some strong technicals. As I said, I gave the example within the ball when Babe Ruth swings at a ball, or when one of the great home run hitters swing at a ball. At the time it hits the ball, you know it's going to take off. That's what you like to see at breakouts. That's what you see at market bottoms. You want to see the energy within the market bottom, so you don't have to worry about it later on. You don't have to look at it every day.
Yeah. That's a really good way of putting it. Milton, what do you think about the semiconductors? I personally have actually been quite long the semiconductors. Why are you short? The fact that you're short is making me a little bit nervous.
Well, short because AI short is negative on the market. SOXX. We're short the ETF. Let me show you why I went short. You're not going to believe it because, of course, I went short because it gapped up into the high. One sign of a top, and it's not the only time it gaps. It gapped here. It wasn't the top, but it gapped into high while Russell was making the isolated one-day reversal. But more importantly, its first down day was the cycle. Montgomery cycle began on January 30th, so it peaked the day before the cycle. Its first down day was on the cycle day. And since there's a lot of emotion in the semiconductor stocks, as you know, it's up 185% off its lows, I think, in just less than 3/4 of a year. It's up 145%. So there's a lot of emotion in the stock. It's something that should cycle, so we short it right now. Right now, you had a gap up today. I tell you, maybe we evaluate on Monday. I don't know. Let me see. The high yesterday was 335.47. The low today was 335.87. You had a 40-cent gap. This is I don't want to say it's bullish because it's very difficult to find bullish indicators exactly one day after a low. You see it, but usually you'll see it 2 days after low or 3 days after low. And you saw it in 2025 in April, a day before the low. But we'll see. I might change my mind. I might cover my short on this. But if the market's going down, I think semiconductors would lead to the downside. So that's why I shorted it, and it was a cycle as well involved in it.
Any other buy or sell signals or things you find interesting that have happened in this year?
Well, the most interesting thing is we bought the Korea stocks look good, and we thought Chinese stocks is good. One of my biggest clients, my favorite clients, would not touch China because, and he's probably right, but I'm not as ethical as he is. He wouldn't buy China because they're very non-ethical government, as you for many reasons, besides that non-capitalistic. But I always took the view that once a country prospers, ultimately it will become more ethical because just the way it's been. Capitalism is the most ethical type of system as opposed to communism and socialism. But anyway, I saw Korea, I saw China. In the U.S., I didn't see things to buy. As far as things to sell, maybe we have to wait till the bear market develops before we find things to sell. I would say that the type of top we saw in Russell should tell you that Russell will lead to the downside. On fundamental, the reason Russell lead to the downside because there's many, I think 40% of zombie companies in the Russell 2000. The Russell 2000 doesn't select for earnings, unlike the S&P indexes. The S&P 600, you have to have an earnings criteria to get into it.
For the and the best companies in the Russell that grow their earnings, they go into the mid-cap index.
Yeah, they go to mid-cap, exactly. So what's one of the problems? What's one of the problems considering small cap an asset class? Because every time they rebalance it, you're losing the good companies. Like, it's kind of funny.
Definitely. All right, Milton.
Thank you, Jack. I hope we only covered a small portion of what I prepared to speak about, but I think it was really fascinating and good. I hope you think so as well.
Yes. We'll include the link in your description, both to your institutional service, but also the retail service, where it's a much simpler read.
If I can make an advertisement, the reason I charge $10 a month, because this is what I said to myself. No one will turn this down because it's too expensive. No investor will turn it down because it's too expensive. So everyone should at least invest for a month or 2 months and take a look. They've seen nothing like it. And the best benefit is not a trading portfolio. It's a portfolio for long-term investors with very, very few ins and outs. It's perfect for individual retail investor.
Rob, and obviously, selling and getting out of the market before a crash is valuable, but getting back in the market is really
the most important thing, right?
So much more valuable. Like, I actually happen to have quote unquote sold the top and been bearish before market crashes before, but mostly due to luck. Although actually maybe over 100% of it was due to luck because I had negative alpha at the time. Yeah. But like, if I didn't get back in that one time, I'm thinking of the 2020 crash, and that's just if you nail the bottom. Sorry, if you nail the crash, but you don't get back in, it's worse than just being 100% owning stocks. It really is.
I'll tell you, to be honest with you, I've made the same mistakes you've made.
Yeah.
But that's why I spent, I managed, 3 funds at Oppenheimer. I managed the largest gold fund. I worked for Steiner. I worked for Soros. I worked for Druckenbill. I managed money. But I spent the last 10 years just delving into research, really. And now I wouldn't make, I don't hope I wouldn't make the kind of mistakes because I will blindly follow the indicators rather than follow my emotions or follow what the headlines are telling you or follow what the economists are telling you. I just follow, and the indicators are very robust. So everyone makes the mistake of missing the bottom. That's the worst mistake you can make.
Absolutely.
Fortunately, we built indicators strictly to call the bottoms.
Absolutely. We'll leave it there. People can find you on Twitter at Berg Milton. Thank you, everyone, for watching. Please leave a rating and review on Apple Podcasts, Spotify, and subscribe to the Monetary Matters YouTube channel. Until next time. Thanks for watching. Interested in the Fundrise Income Fund? Click the link in the description to learn more. Until next time.